Good evening, students. My name is Ahmed, and I welcome all of you on the ACCA's official Practice to Pass webinars for the Audit and Assurance exam. And this webinar is definitely for the September 2021 exam. And I hope all of you are doing great with respect to your health. I hope all of you are keeping yourself and your family and your loved ones safe and sound from this ongoing pandemic, which seems to be a never-ending story for all of us. So I really hope so all of you get vaccinated as soon as possible so that we can get rid of this problem. Okay, now what about audit and assurance exam? The audit and assurance exam is scheduled to be held on 6th September, that is Monday. And for most part of the world, I hope so, for all the possible parts of the world, I really hope so that this is going to be a center-based exam, because majority students and the learning providers do not appreciate the remote exam thing because of the technical issues which are sometimes inevitable, and we have to face the music. So with all those positive assumptions and with all those positive uh, thinking, let's start this Practice to Pass webinar for September 2021 exam. Okay. Okay. As I told you that my name is Ahmed and I'm an ACCA member, and I'm currently teaching in SBM. We call it SBM. The name is School of Business and Management, which we are a gold status learning provider, and we are here in Islamabad, the capital of Pakistan. I am currently teaching three main subjects of ACCA. Number one, performance management, the nightmare of ACCA without any shadow of doubt. And then comes audit and assurance and advanced audit and assurance, double A and triple A. I am also involved with SEMA and CMA, and in the recent past, before COVID-19 hit us badly, I had distinctions in performance management, double A and triple A as well. So that was a bit about me. Okay, now what about exam format? This particular paper, Audit and Assurance, has got the most difficult exam format among the skill level papers. I am right now considering F5, F6, F7, and F8, F9. I'm ignoring F4 for now. So among these 5 exams, from performance management to financial management, the most difficult exam format is for the double A paper. Why I'm saying that, let me justify my statement. F5, F6, F7, and in F9 exams, there are 3 sections. Section A and Section B is something which has got nothing to do with your IT skills, which has got nothing to do with your typing speed, which has got nothing to do with how smart you are when it comes to spreadsheet or Microsoft Excel. But when it comes to double A exam, we are not having 3 sections. Instead, we are having 2 sections, Section A and Section B only. In the Section A, we have got 3 OTQs or MTQs, and in the Section B, we have got 3 long questions. So what I'm trying to say is that instead of 60 marks being objective oriented, we have only got 30 marks which are objective oriented. The Section A has got 30 marks in it. There will be 3 MTQs or 3 OTQs that will be tested, and each and every MTQ will have 5 questions in it. So every OTQ have got 5 questions in it, and every short question will be of 2 marks. So that makes 5 2s are 10. 5 2s are 10, another 5 2s are 10, and lastly 5 2s are 10. That gives you 30 marks in total when it comes to Section A. When it comes to Section B, we will be having 3 long questions. The first long question will be having 30 marks. The second and the third long question will be of 20 marks each. So the Section B, which requires your typing skills, which require your your command over your on your typing speed and your IT skills, it is of 70 marks. What about section A and what about section B? As far as section A is concerned, the examiner can test anything with respect to section A. So for section A, you have to be prepared for all the exams, all the course content. Anything can be tested in section A, from a minor topic to a major topic. Anything can be tested in the section A. But in the section B, there are certain things which are heavily tested, and there are certain things which are tested with on a lighter note. Okay, what about course content? The course content of this AA exam can be divided into two portions. Number one, the major areas. Number second, the minor areas. There are three major areas. There are four minor areas. Overall, that makes 7 areas in total. So the course content is, we have got ethics and acceptance. We have got audit risk, which is a major area. Then we have got internal control systems, another major area. Then we have got substantive procedure, another major area. So number second, third, and fourth are the major areas. Then we have got corporate governance, internal audit, and last but not the least, review and reporting. The fifth, the sixth, and the seventh are minor areas. They are not major areas. As I told you earlier, in the section A, anything could be tested. Any area of the syllabus can be tested. But generally speaking, minor areas tend to be tested heavily in the section A. But that does not mean that the major areas cannot be tested in section A. So in short, anything can be tested in section A. As far as section B is concerned, we will be having 3 long questions in the section B. And for those 3 long questions, the main focus of the examiner will be on the major areas. So for the section B, we have got total 70 marks. On an average, out of those 70 marks, the 50 marks will be from the major areas, and on an average, 20 marks do come up from the minor areas. So this exam focus and this exam format reveals one thing, that you cannot heavily rely on the major areas and you cannot ignore minor areas, because the minor areas will be part of the section A and the minor areas will be part of the section B as well. Out of 30 marks, roughly 20 marks in the section A will be from minor areas, and in the section B, out of 70 marks, again at least 20 marks will be from minor areas. So if somebody wants to pass this exam in the September 2021 attempt, one has to make sure that along with the major areas, one has to focus on the minor areas as well. The recent pass rates of audit and assurance are not that promising. Among the skill level exam, if you are going to compare AA with, let's say, FR, if you are going to compare AA with tax, if you are going to compare AA with financial management, the pass rates of AA are quite disappointing. The recent result has revealed that FR and financial management have gone beyond 50%, but AA hardly crosses 43%. You can see that it's 36%, 38, 36, 41, 39, 43, 39. So you can safely say that the average result for AA is not beyond 40%. On the other hand, the average result for tax, the average result for FM, the average result for FR is well above 46, 47%. Sometimes it touches 50%, and in the recent result, they have crossed 50%. So you have to realize that this paper is a tricky one, and it requires some extraordinary effort from your side and from my side as well, definitely. Okay, before we start studying, before we go into the details of the syllabus, before we go what the examiner is going to ask, let's explore why majority of us fail in this particular paper, why students fail in audit and assurance. There are many reasons, and we need to understand those reasons on the day one of this P2P webinar, because we want to make sure, and I will try to make sure that in the next 15 hours or so, in the next 5 hours of this webinar, I will try to address these issues. I will try to emphasize on these issues so that we are not going to commit such mistakes in the September 2021 exam. So the burning question is why students fail, why the failure rate of the AA is on the higher side. The first and the most common reason of failure is poor time management. Now, the poor time management can be divided into two categories, or the poor time management can be because of two possible reasons. Number one, there is a student, for example, myself, Ahmed, and Ahmed has got, let's say, poor typing speed. So even if I've got command over the subject, even if I know the marking schemes, even if I know how to address the audit risk, even if I know how to explain the control deficiencies, even if I know how to construct a valid substantive procedure, even if I know how to explain a potential corporate governance deficiency, even if I know what's the impact of the potential material misstatement on the audit report, even if I know everything, the whole subject and the whole course content, because of my poor typing speed, I might end up attempting 80-85 mark paper, and as a result I might end up failing the exam at somewhere 46, 47, 48. So if somebody is going to attempt 85 mark paper and he or she is going to score 47, what do you think? Who is going to get all the blame? Who is the culprit here? If you are going to attempt 85 mark paper and end up scoring 47, who's the culprit here? I don't see anyone except the student himself or herself. Why? Because if you could score 47, 48, 46 out of 84, 85, you could have easily managed a pass if you have attempted the whole paper. So the first reason is called poor time management. And if I'm going to divide poor time management, I would come up with two possible reasons. First, poor typing speed. You can address your typing speed, you can overcome your typing speed, you still have got good enough time. I told you I will explain why students fail, and I will tell you the solution as well. I will try to make sure that in the whole session of this webinar, I'm going to emphasize on this particular slide which is on your screen right now. So how can you address poor typing speed? See, if you are going to overcome your poor typing speed, this is not only going to help you in passing this particular paper, audit and assurance, this is going to help you in overall, clearing all your ACCA exams, because all ACCA exams are computer based exams now. What about AAA, the most challenging time pressured paper of ACCA? So if you have got good typing speed, not only AA will be passed, more importantly, in a year's time, in a 6 months time, you will be able to pass SBL and AAA, those theoretical papers which have got no numerical whatsoever in it. How can you overcome your typing speed? You got to make an account on typing.com. It's a website free for all. You can sign up as a student just like you sign up on Instagram, and you can make your account and you can invest half an hour daily on typing.com. Within 20 to 25 days, spending half an hour daily on typing.com will ensure that your typing speed will be good enough to pass AA exam. And if you have got good typing speed, this will be an important asset for the rest of your life, for your future, for your career. So poor typing speed. Okay, poor time management. Another possible reason of poor time management is the lack of exam practice. Remember, if you want to make sure that your time management is well addressed, you need to attempt mock exams, you need to attempt questions under strict exam conditions. It's not like that you are reading the question and then you figured out some point, you thought of it but you didn't type. Okay, you thought of that point and you type a point or two, then you took a break, then you went on for a walk, which you might not go. You started using your cell phone, then you had a break and you started watching TV, then you realize, oh, I got to resume my studies, and then you again started typing that particular question. No, not this way. You need to have exam focus and you need to have exam pressure on yourself. So you need to make sure that you need to address your time management issue by making sure that all questions are solved within a time frame, with an exam pressure, without any interference from a third party, without any interruption. So that is how your time management skills will improve. So why students fail? Poor time management. You need to improve your typing speed, and you need to make sure that whenever you are solving a question, it is time bounded. Okay, second reason why students fail the AA exam. The second reason is very, very, very poor score in the section A of the exam. If somebody has just joined us right now in the webinar, the section A of the exam will have 3 OTQs in it. Every OTQ will have 5 questions in it. Every question will have 2 marks. So that makes 5 2s are 10, 5 2s are 10, and another 5 2s are 10. That makes 30 marks in the section A. Now, I conducted the last webinar and the second last webinar of the AA as well, the March 2021 and the June 2021. Now, over the period of last 6 months, I received a very welcoming response that students tend to be very comfortable when it comes to section B, but students are struggling in section A. If a student is failing at 48, and when I'm going to have a chit chat, or when I'm going to inquire certain things from that particular student, how did you score in the section B? The student comes up with an explanation that my section B went smooth. I followed everything went fine. Audit risk was good. I had a good go at the control question. Everything went fine. But when I ask about the section A, generally speaking, the students reveal this thing, that they did not attempt OTQs at home using Kaplan or BPP kit. Majority students say that they used either one kit or no kit whatsoever. Hardly 10% of the students come up with an answer of my question. Yes, we did both kits with solutions. Otherwise, greater majority students tend to ignore the OTQs when it comes to AA exam. Now you have to make sure, today is 3rd August and your exam is on 6th September. So you have got solid 34 days. And if you are going to add both the OTQs of the Kaplan kit and the BPP kit, they will not exceed more than 200, for instance. So if you are going to attempt 3 OTQs on a daily basis, starting from today, 3 OTQs on a daily basis, starting from today, at the end of the day, when your exam will be around the corner, your both kits MTQs will be finished. So why students are generally failing AA exam? Because they are not paying good enough respect and attention to their section A. All over the world, AA students have got a very wrong assumption in their mind that if they are good with respect to the course content, if their section B is well prepared, if their typing speed is good, they are automatically going to score good enough marks in section A. But this is not the case. If you want to pass this exam, you need to score 24 out of 30 marks in section A. 22 is acceptable, but on 20 out of 30, you are sitting at the border, and you don't wish to be at the border. You don't wish to be at a point of time where there is do or die. So you need to score more than 20. You need to score 24. Your target should be 24 or more. One mistake per OTQ is acceptable. That gives you 24 out of 30 marks. How we are going to address this issue? Unlike my last webinars, I am going to cover OTQs on a daily basis. In the last webinar, or for that matter, on the second last webinar, I did not carry section A on a daily basis, but this time around I need to carry OTQs on a daily basis because this is getting serious. The students are not paying good enough attention to section A. Why? Because unfortunately tutors such as me all over the world, the tutors are not paying good enough attention to section A. I remember once my colleague, my friend who teaches somewhere in the Middle East told me that I am unable to address OTQs during the session because I don't have time for that. I don't have credit hours for that. Now what happens then? If a tutor is unable to address OTQs during the session, this has a negative impact on the preparation of the students. The students tend to ignore the OTQs as well. So we are not going to commit this mistake this time around. We are going to address OTQs on a daily basis in this webinar, and you are going to continue that practice for the rest of the next month or so, the time which you have got up until your exam. So let's go to the third reason why students fail in the AA exam. By the way, let me tell you, these 10 minutes which are ongoing right now at the moment are the most important 10 minutes of this whole session of webinars among all 5 days. This is the most important time. You need to, if somebody is good with this particular slide, if somebody has understood these 5 points, if somebody has committed himself or herself for these 5 things, I can guarantee you that you will pass this exam. This will be a walk in the park for you on 6th September 2021. So poor time management, poor score in section A. One last thing, if you want to score good in section A, there are two steps. There is a two-step approach. A, you need to attempt 3 OTQs on a daily basis, but that's not enough. You need to read out the solution of those OTQs as well. You need to make sure that you know why option number 1 is correct. You need to make sure that you are crystal clear that why option number 2 is incorrect. You need to be crystal clear what changes could have been made in the statement 3, for example, that would have turned the statement 3 from being a false statement into a true statement. This is the kind of preparation you need to have when it comes to section A. Only then you will be able to score 24 marks or more in the section A. I can tell you one thing for now, 6th September 2021, you will find section B not so difficult. You will find section B relatively easy. But I'm telling you right now that section A will be a very, very difficult exam section for you. So if you want to make sure that you score 24 or more, you need to spend quality time on the solutions as well. Okay, the third reason why students fail this particular exam so much. In the section B, we have got 70 marks, 30 marks, 20 marks, and 20 marks, 3 long questions. All those 3 long questions will have sub parts in it. Let's say, for example, question number 30, the question number 1 having 30 marks in it might have 5 parts, A, B, C, D. Question number 2 having 20 marks in total might have 2 parts, part A 4 marks, part B 16 marks. There are certain parts in the section B which have got nothing to do with the question itself, which have got nothing to do with the story of the question, which have got nothing to do with the scenario of the question. Those questions are called knowledge-based questions. And if I'm going to use examiner terminologies, the examiner says these are bookish requirements. These are the requirements which are straight out of the book. So if you know those knowledge-based questions, you are going to score full marks. And if you know nothing about those particular requirements, if you are not well prepared for those knowledge-based questions, you will end up scoring nothing for them, because you cannot create those answers. Generally speaking, 10 to 15 marks are for the knowledge-based questions. So now imagine I'm going to appear on 6th September 2021. Let's say I scored 16, 18 marks in the section A. Let's say my typing speed was not that great. So I ended up attempting 85 mark paper. Now guess what? There were, out of those 85 mark which I attempted, 10 marks were for the knowledge based, and I was not good with knowledge based. I was not well prepared for the knowledge based. How much I'm going to score in the knowledge based? Hardly 2-3 marks. But just imagine if I was well prepared for the knowledge base, how much I would have scored? 10 out of 10, 9 out of 10 at least. Worst possible, 8 out of 10 if you are well prepared. So knowledge base is something which has got nothing to do with exam technique. It has nothing to do with your English skills. You don't have to read the question for that. If you know it, you know it. If you know it, you got to type it without any hesitation. So the third reason is for the high failure rate, that students are generally not well prepared for the knowledge base. On a daily basis, I'm going to tell you at the end of the webinar, in the last 10 minutes or so, on a daily basis, that what is the knowledge base you need to prepare for your knowledge base section, which comes as part of the section B of your exam, the sub requirements. On a daily basis, I'm going to tell, if I'm going to forget any day, you have to remind me. Okay, the fourth reason of why students fail this particular exam is the exam technique. The exam technique has got to do with all the course content, but specifically the exam technique has got to do with the major areas of the syllabus. And why exam technique is so crucial and critical, I am here for that thing. Why I'm sitting here today? Because I want to teach the exam technique to you. The exam technique for the major topic audit risk is my agenda for day 1. The exam technique for the major area number 2 controls is the agenda for tomorrow. And the most important thing, substantive procedure, which has got a huge exam technique. We will be addressing exam technique for substantive procedures on the day 3 and also on day 4. So let's not take tension of this point number 4, because this point number 4 will be covered within this session of webinar. Last reason why students fail this AA exam. There are 3 major areas, as I told you, risk controls and substantive procedures, but there are minor areas as well. There are minor areas as well, such as number 1, ethics, number 5, corporate governance, number 6, internal audit, and last but not the least, review and reporting. Are these important? Yes, they are important. They are less important when you are going to compare with audit, risk, internal controls, and substantive procedures, but they are equally important if you want to pass this exam. The minor areas will make up 40% out of the 100%. The minor areas will make at least 20% out of the section B. The minor areas will make at least 20% out of the 30 mark section A. So is minor area important? Yes, because it is going to make 40 marks. So do we need to spend quality time on minor areas? Do we need to pay good enough attention to minor areas? Yes, we have to. And if somebody is not prepared with respect to minor areas, the chances of failure are on the higher side, and we want to mitigate it. In fact, we want to completely reduce it. So this is it. The summary of this particular extremely important point of time is that we need to work on typing speed by making an account on typing.com today, right after this webinar. We need to make sure whenever we are attempting a question, that question should be time bounded, not we need to finish a particular question in a stretch. That's how we are going to be exam focused. We need to solve at least 3 OTQs on a daily basis. I would rather recommend 6 OTQs per day. 3 in one stretch, 3 in one stretch, 6 OTQs per day. We need to make sure that we are fully prepared when it comes to knowledge based. Exam technique is my problem, don't worry about it. And you need to make sure that minor areas are part of your preparation. And for minor areas, which almost makes 40% of our final exam, I'm going to invest the 5th day completely on the minor areas. The 5th day of this webinar will cover all the minor areas such as ethics, corporate governance, reporting, and so on. Okay, this is it. Okay, what's my plan? Day 1, audit risk. Day 2, internal controls. Day 3, substantive procedures. Day 4, I will re-emphasize on substantive procedures along with review and reporting. Day 5, corporate governance, a minor area, ethics, minor area, internal audit, minor area, subsequent events, minor areas, and last but not the least, we are going to discuss what changes do we have in the syllabus of AA, on the last day. By the way, there are no major changes in AA, so you don't have to worry about it. Okay, now I have to start the main event of the day. And before I start main event of the day, if there is any question, I can address those questions for now, and then I can move on. Okay. Okay, minor areas are ethics. Vidisha has asked what are minor areas. Minor areas are ethics and client acceptance procedures. corporate governance is a minor area, internal audit are a minor area. Minor areas are tested in section A and section B. When it comes to section B, the major focus will be on the long question, on the major topic audit risk or internal controls or substantive procedure. But there is a possibility that there will be a certain part about corporate governance. There will be a 5-mark part for ethics. So minor areas will be tested over there as well. Okay. That's true, sir. Even I find AA MCQs very hard. That this is absolutely true. Those who are failing AA exam, when I get to know the feedback from them, their feedback is that they struggled in the section A. Even some of the honest reviews and feedbacks which I received are, sir, hardly I would have scored 8 marks, maximum 10 marks. The student comes up to me and he or she tells me that I scored 47 marks in the attempt in the AA exam, and the student reveals that, sir, hardly I scored 8 or 10 marks in the section A. So how disappointing is that? You did all the hard work, you did all the crucial part, but you should have come up with the a little effort on the section A as well, but you ignored it, and then you have to pay the price. So we are going to emphasize on OTQs on a daily basis. Okay, what about time per question? I am going to reveal at the end the time management per question. No, you have to wait for that. No sir, no question. Okay sir, please could you tell me more about knowledge based questions? Knowledge based questions are questions which are straight out of the book. The examiner is not going to provide any background information for that in the exam question, such as explain the 5 fundamental principles of ACCA's code of ethics and conduct. So if you know the definitions, you got to write them. That's it. These are knowledge based questions. Okay, there is a question from Mohammad Akib. Sir, is solving both kits necessary for the long questions? Akib, you don't have to attempt both the kits. You don't have to go for both the kits when it comes to long questions, but when it comes to OTQs, definitely you need to solve both kits. Okay, Muhammad Salman and Asad Siddiqui, unfortunately we all are having different time zones, so I will give you a break, but I will give you a break after a while, don't worry. Maruk has asked, is it necessary to read the book or just kit would be enough? No, it is highly recommended that you should read the book. Yes sir, I will provide. Okay, we will discuss the changes on the 5th day. Okay, Mohammad Atar has asked how many marks can we expect from corporate governance and ethics in section B? All the minor areas, if I'm going to accumulate all of them, 15 to 20 marks. Okay, Somya, I will answer this one, that how to divide your time. I will address time management. Don't worry, I will address time management. If we are preparing for more than one exam along the work, would you suggest how to best prioritize preparation for exam? Please. Well, for now, I would suggest that give your most when you are having the most fresh mind, try to study AA, because this is a theoretical paper and you need to study when you are relatively fresh. Yes, Laiba, I will share a study plan at the end of the webinar for the rest of the days. I will share a plan. Presh has asked, I have not covered substantive procedures. If you haven't covered substantive procedure, no problem. I will start from the scratch. Okay, Mr. Hamid has, and he has seconded me that he is saying that he scored 49 marks due to minor areas. So on the exam day, where Hamid struggled, maybe on the OTQs, and more importantly, what he's suggesting, that he was not well prepared when it comes to corporate governance, ethics, internal audit, and he scored 49. Just imagine he was well prepared for those minor areas, he would have gone beyond 56, 57. Okay, is there a, okay, how many questions? Is there any chances of remote invigilation? I really don't think so that there is any chance of remote examination, because the vaccines are all over the place. ACCA is going to emphasize on the last day that if you are not vaccinated, you might not able to enter the examination hall. That's my point of view. This is not an official verdict by ACCA, but I am pretty confident about my statement. ACCA is going to come up with a statement that if you are not vaccinated, you cannot enter the examination hall. That's my assessment of the things, how things are shaping up. So you got to make sure that you are vaccinated as soon as possible, because if you are not vaccinated, your exam would be at stake. So do it as soon as possible. Okay, Mr. Ajit is saying, I'm finding it difficult to express my answers with audit jargons. Could you please advise how should it be mitigated? My first advice is you need to attend all the 5 webinars, all the 5 days of the webinars starting from today. The first recommendation is, and then you have to follow the techniques, and you have to reattempt the questions which I will be, addressing in this webinar. That's how your jargon will be developed. Marok, I will be sharing a plan. Don't worry. Will the lecture be promptly uploaded? Okay, the lectures will be uploaded within next 24 hours. Okay. I think this is it. How do we work on drafting, since we are not used to a lot of drafting for other papers? Sir, can you get passing marks by focusing on the major areas, minor topics? Sir, if you are going to focus on major areas and if you're going to ignore minor areas, you will be at stake, you will be at risk. But if you are going to focus on major areas and you are going to spend at least average time on minor areas, the chances of passing the exams are sky high. Don't ignore minor areas. Ahmed, if you want to have links to the previous webinars, I can provide you that, but I'm not recommending or forcing you. So I will share what questions I did in the last webinar. I will share that. But if you're good and if you're comfortable with this webinar and you have understood all the things, you don't have to go back and attend those webinars. Okay, last question for the day. Last question for the day is from Adil. I feel difficulty in remembering substantive procedures. You don't have to memorize substantive procedures without concepts. I will be discussing web substantive procedures on the day 3 and day 4. And you tell me on day 5, are you comfortable with substantive procedures now? You will be comfortable in substantive procedures at the end of the day 4. So for now, let's ignore substantive procedures. Let's imagine they don't exist. Sir, my exam F9 with AA, is it manageable? Yes, Mavish, it is manageable. All you have to do is remain honest with yourself and make sure that you follow this webinar and follow the instructions. Automatically things will shape up. Automatically things will, things will be clear. Okay, let's continue. Okay, let's continue, and let's start with the first major topic. Today's agenda is audit risk. What is audit risk? First of all, let's try to understand what is risk. I have already expressed I will be starting each and every topic from the scratch. I'm assuming that all of you have got no knowledge when it comes to audit risk. I'm not assuming that some of you have already studied it from any XYZ tutor or from any other place. I'm assuming that all of us are on same platform, on same level, and we are starting from the scratch. Okay, what is risk? First, the first question is, what is risk? See, any potential unpleasant event is risk. If you are a cricket batsman and you are opening an inning for your team, you might not end up scoring runs and you might get out early. That's the risk you are facing as a batsman. If you are a goalkeeper and you are defending a penalty shootout, you might not be able to save the penalty and the goal will be scored against you. That's the risk you are facing as a goalkeeper. If you are if you're a rider, yeah, a motorcyclist, you will slip on a slippery road, unfortunately, and you will be injured. That's the risk you are facing as a motorcyclist. Similarly, now the question is, what is audit risk? And in order to understand what is audit risk, you got to understand what is the objective of the auditor, why you are appointed as an auditor. An auditor is appointed so that the auditor and the team of the audit team, they come up with independent examination of the financial statements. And when the independent examination of financial statement is over, when the auditor has obtained the sufficient appropriate audit evidence, the auditor will be able to come up with an unbiased independent audit report. And in that independent audit report, auditor will express the audit opinion, the most important thing, the audit opinion. So why we are hired as auditors? Because we need to come up with independent examination of the financial statements. Mind you, the subject matter for an auditor is financial statements. And when I have audited the financial statements, I will come up with an independent audit report and I will express my audit opinion. Now back to the original question. What is audit risk? What if my audit opinion is not correct under the given circumstances? Let's imagine this set of financial statements is not expressing a true and fair view, but on the contrary, unfortunately, the auditor comes up with an opinion that the financial statements are expressing a true and fair view. So the whole objective of the audit has been failed by the auditor. The auditor is saying that the financial statements are expressing a true and fair view, but unfortunately the financial statements are not expressing a true and fair view. So this chances of auditor expressing an incorrect audit opinion is called audit risk. What is audit risk? That an auditor might come up with incorrect audit opinion. The chances of expressing an incorrect audit opinion is called audit risk. Okay, if you are clear with the topic itself, audit risk, I might be wondering as a student, an auditor is so well qualified. An auditor has passed all the reporting exams, all the auditing exams. An auditor is familiar with all the reporting framework, all the accounting standards, all the auditing standards, all the relevant laws and regulations. An auditor is a fully qualified member of ACCA, or for that matter, any other chartered accountancy body. An auditor is someone who had his or her practice in the audit firm. He went for at least 3 years in the audit firm. He went on to, work under the supervision of a supervisor. Then he or she himself became the supervisor, then the audit manager, then the engagement partner. After all those trainings, after all those quality control procedures, after all those supervisions, still incorrect audit opinion. That's very disappointing. Now the burning question in my mind is, as a student, if an audit firm is so well organized and so well trained, why there is an audit risk altogether? I've got a reservation. I want to know why audit risk exists. I wish audit risk would have been zero. If auditor is so well trained and so well competent, so well resourced, so well, everything is on the higher side, why audit risk exists? So the audit risk can be divided into two portions, or I can say there are two reasons behind audit risk. The first reason is the financial statement risk, also known as the risk of material misstatement in the financial statement. I've written ROMM, that's the short form. Risk of material misstatement in the financial statement. What do I mean by risk of material misstatement? The financial statements which I am supposed to audit as an auditor are generally at risk of material misstatement. So maybe when I'm going to audit your company's financial statements, your assets are overstated, your revenue is overstated, maybe your expenses are understated, maybe your liabilities are understated. So there are chances of material misstatements in the financial statement, and that chances of financial statements being materially misstated is called the risk of material misstatement. Just imagine for a moment, just imagine you were auditing, let's say, Apple Company Limited, and their financial statements were absolutely flawless. They had a magical thing going on, and there is 0% material misstatements in the financial statements. So if the risk of material misstatement in the financial statement is nowhere, 0%, how come you express an incorrect audit opinion? So if the risk of material misstatement is 0%, automatically the audit risk becomes 0. If the risk of material misstatement is 0%, as an auditor, you are never going to express incorrect audit opinion. But unfortunately, in a real world, the financial statements are never free from risk of material misstatement. There are material misstatements in the financial statements. Now, what are the reasons of material misstatements in the financial statements? Sometimes fraud, sometimes error. Error is unintentional, fraud is intentional. So the risk of material misstatement is there. Misstatements can be categorized into three categories, and that's a knowledge-based thing for your exam. Material misstatements, I told you risk of material misstatements. The terminology misstatement can be categorized into three categories, and this is something which can be tested as a knowledge-based. Now this is important, you got to be very serious about it. The first type of misstatement is called factual misstatement. Factual misstatement is something which is crystal clear. So you added something and it turns out to be 470,000, but the client has incorrectly added up as 370,000. There is no shadow of doubt on it. This is absolutely crystal clear that the client has gone wrong when it comes to arithmetical accuracy. So this is a factual misstatement. Maybe the client has incorrectly accounted for something as 10,000, although that should have been added as 110,000, so the difference is 100,000. So this is called factual misstatement on which there is no shadow of doubt. So that's the misstatement type number one, factual misstatement. The second type of misstatement is called judgmental misstatement. What is judgmental misstatement? As an auditor, I am having a different point of view as compared to your point of view. Imagine yourself as a client. Your point of view regarding the provisions for the warranty claims is different as compared to my point of view. For example, your assessment is that provisions for the warranty claims should not be more than 5%, but my point of view is that it should be at least 10%. Now this is judgmental. You might be correct, I might be correct as well. So this is called judgmental misstatement. Definitely me being the auditor, the superior authority will prevail. My point of view will prevail, but this is judgmental misstatement. Generally speaking, provisions, the estimates, the useful lives, these are all judgmental areas of the audit, the judgmental areas of the financial statements. The third category of misstatement, again for the knowledge base, it's called projected misstatement. What is projected misstatement? Imagine the total value of the vehicles were, let's say, $100,000. As an auditor, I selected a sample of 10,000 out of that 100,000, and I found out of 10,000 there is a misstatement of 1,000 only. Out of that 10,000 there is a misstatement of 1,000, and the materiality level is, let's say, 5,000. Now you tell me, 1,000 out of 10,000, is it material or immaterial? Considering the materiality level is 5,000. Now the misstatement is 1,000, the materiality level is 5,000. Apparently it's not material because 1,000 is well below the materiality level of 5,000. But you got to realize that 1,000 is a misstatement out of 10,000. If you are going to apply your test on the whole population, which is 100,000, 1,000 out of 10,000, which means if you're going to apply this misstatement on the whole population, the overall misstatement will be 1,000 divided by 10,000 multiplied by 100,000. Overall, the misstatement would be would be, I'm not saying should be, I'm not 100% sure, but apparently there it seems to be the misstatement would cross 5,000 and the misstatement would end up somewhere around 10,000. Is 10,000 material? Yes, it is definitely very, very material, because as I told you, the materiality level is 5,000. So this whole concept is called projected misstatement, where you are going to apply your procedures on a limited sample, and then you are going to, you know, apply the results of it on the entire population. This is called projected misstatement. So that was all about knowledge base. There are three types of misstatements: factual misstatements, judgmental misstatements, projected misstatements. You got to learn the definitions of these three as a knowledge base for your final exams. Let's continue audit risk. So what is audit risk? There are two components of audit risk. Number one, the risk of material misstatements in the financial statements. Risk of material misstatements. The financial statements are vulnerable. There could be misstatements in the financial statements. Now the question is, why financial statements are at risk of material misstatement? Why, generally speaking, the financial statements tend to contain material misstatements? Because of two possible reasons. Number one is called inherent risk. Number second is called control risk. Now, what is inherent risk? Inherent risk has got to do with the nature of the company. Let's say there are extraordinary pressures on the employees. Let's say the employees are not competent enough, so they are going to make errors. Let's say the employees have got a huge pressure, they need to deliver certain level of financial statements. Maybe they are trying to get their hands on the stock exchange listing, so there is a pressure on the management, on the company, that they need to present a healthy financial statement. This is all inherent risk. Maybe there is a very competitive environment, maybe there is COVID-19 going on and the company needs to make sure their financial statements are apparently healthy. So this is inherent risk. The unusual pressures, the environment, the overall, complicated tax system, these are called inherent risk. If the inherent risk is on the higher side, the financial statements tend to become materially misstated. The chances of financial statements being materially misstated gets higher and higher. The second reason why financial statements are generally materially misstated, the second reason is called control risk. There is an obligation on the management of an organization. They need to design and implement an internal control system. And if their internal control systems, if their control systems are not working effectively, as a result, frauds and errors may go undetected. Now just imagine there is an audit client and their control systems are not working effectively. What will happen then? Frauds and errors may go undetected. And if frauds and errors go undetected, what's the consequence of that? The financial statements becomes materially misstated. So these two reasons contribute over the risk of material misstatement in the financial statement. Okay, now what is the second reason of audit risk after risk of material misstatement? The second reason is called detection risk. Detection risk. Who's the detector here? The auditor. So it means the detection risk has got to do with the auditor. Please realize, inherent risk and control risk are not auditor specific risk. An auditor has got nothing to do with inherent risk. An auditor has got nothing to do with control risk. As an auditor, I am going to evaluate inherent risk. As an auditor, I am going to evaluate control risk. But as an auditor, I cannot minimize or mitigate inherent risk. That's beyond my control. As an auditor, I cannot mitigate inherent risk. I cannot minimize control risk. If somebody has to mitigate inherent and control risk, it's the management. But detection risk is auditor specific risk. I have to control the detection risk. What's detection risk? As an auditor, I might not be able to detect the material misstatements in the financial statement, and that's the definition of detection risk. What are the components or reasons of detection risk? See, the risk of material misstatement has got two reasons: inherent risk and control risk. And with the similar, theme, detection risk has got two reasons. Number one, sampling risk. Number second, non-sampling risk. What is sampling risk? As an auditor, I selected a sample and I found that sample all right. So I drew a conclusion that overall the financial statements are giving a true and fair view. But as a matter of fact, though that sample was not truly representing the population, and my opinion is not correct. So if the sample is not truly representing the entire population, if a sample is not truly representing the entire population, this is called sampling risk. Now, what is non-sampling risk? If your sample is truly representing your entire population, but still as an auditor you made a judgmental mistake, or you were not competent enough, or you made a wrong judgment, or your conclusion was not correct. So there is anything other than the sample size, anything which has got to do with the sample, any mistake made by the auditor, anything, time pressure, anything, this is called non-sampling risk. Now, I told you that I will be addressing these things throughout my webinar. You got to work on your time management issue. We will be solving at least 3 OTQs at the end of today's webinar and on a daily basis. What about knowledge base? I have already shared knowledge base, the 3 types of misstatements. Now another knowledge base for you. You got to learn the definition and type the definition of audit risk, the definition of risk of material misstatement, the definition of inherent risk and the control risk, the definition of detection risk, the definition of sampling risk, and the definition of non-sampling risk. I remember when in the question section somebody asked me a few moments ago that what should we expect in the knowledge base. Now you should know what should you expect in the knowledge base when it comes to risk. Okay, I hope I'm addressing your questions. Okay, the main event, and then we are going straight to the past papers. Now the next 5 to 10 minutes are the second most important part of today's webinar, because the first most important part was this one, why students fail. Nothing is more important than this file, this particular slide. Nothing is more important. Nothing can beat this one. If you are going to religiously follow all these 5 things, you will pass, walk in the park. You might end up scoring a distinction and making yourself proud. Let's hope for the best. Okay, what about the exam requirement? There is one exam requirement. That's it. The good news. The good news is when it comes to audit risk, there is no variety of exam requirements. When it comes to audit risk, in every exam sitting, September 2021, let it be June 2021, or it was March 2021, or if it is going to be December 2021, there is one exam requirement, and that's it. No hanky panky from the examiner, and that exam requirement will be tested in every exam sitting for sure. So if anyone, if your friend who is going to appear, or if your friend of a friend, if anyone is not crystal clear with respect to this particular exam requirement, it's a very sorry and disappointing situation. So all of us have to make sure that we are crystal clear with respect to this exam requirement. And in fact, we have to make sure that at least we need to teach this particular exam requirement to at least one of our friends, so that we becomes more crystal clear. So you got to make sure that you got to grasp somebody, and you need to ask, are you attending webinars? And if that particular individual comes up with a negative answer, you need to tell him that I would like to teach you one thing which is going to be in your exam, and that is describe audit risk. Describe audit risk, and after and there is another requirement by your examiner. Explain the auditor's response against the risk. Let's keep it simple. So there will be a story, there will be a scenario in the question. As a student, you are going to read that particular story, that particular scenario, and out of that story, out of that scenario, you got to identify audit risk. And when you are going to identify audit risk, You are going to identify audit risk from the question itself. No creative writing. You are not going to identify audit risk out of your mind. The audit risk will be there in the question. Once you have identified the audit risk, you got to explain it. Once you have explained it, the first requirement is fulfilled, that is describe audit risk. So I hope all of you have just realized that when I say describe audit risk, there are two parts of it: identification of the audit risk and the explanation of the audit risk. And overall, the description of the audit risk, which is identification and explanation, will give you 1 mark. And then you have to come up with the auditor's response. If there is a risk somewhere, do you generally address that? If there is a risk, if there is a spark, electric spark going some, unfortunately there is an electric spark in your room, are you going to address that, or are you going to say let's see what happens? I hope and I'm sure that you will try to address that. With the similar logic, if there is an audit risk, what is supposed to be done by the auditor? I think the auditor and the engagement team and the auditors, they need to react, they need to respond. So the examiner is going to ask a simple question: describe audit risk and explain how are you going to react. What do I mean by auditor's response? Auditor's response means how are you going to react, how are you going to respond, what is your plan of action. Now the question is, how many audit risks the examiner is going to ask you for the description? At least 5, but maximum 8. Describe 5 audit risk, 6 audit risk, 7 audit risk, 8 audit risk. When it comes to AA exam, the examiner is going to come up with either 5, 6, 7 or 8. The examiner is not going to keep it an open-ended. The examiner is going to categorically mention describe 7 audit risk, describe 8 audit risk. It is not going to be describe audit risk. When it comes to AAA exam, the examiner does not reveal, she does not reveal in the AAA exam that how many audit risks you need to explain. According to the marking scheme, you have to judge. But when it comes to AA, the examiner is going to reveal how many audit risks are expected from you. And quite interestingly, a good news for all of us, if the examiner is going to ask for 8 audit risk, at least 10 audit risk will be available in the question. If the examiner is going to ask for 5 audit risk, at least 6 audit risk will be available in the question. So this is a sigh of relief. We will be able to choose if a particular audit risk, we are finding a particular audit risk difficult, or we are not good at the response of it, we can ignore it. But if you found a particular audit risk, a pleasing one, you are comfortable with it, straight away go to the platform and attempt it. Don't read the whole question and then start attempting the question. Don't do that. One of the very important exam technique is, if you read the first 3 lines and you found one particular audit risk in it, straight away go to your audit of your constructed response portion and go to your platform and attempt that particular audit risk. You got to come up with audit risk and auditor's response, 2 headings. That's it, and then you have to attempt it. Okay, what about the marking scheme? What about the marking scheme? As I told you earlier, the examiner is going to say describe audit risk, and the description of audit risk has got 2 parts in it: the identification of the audit risk and the explanation of the audit risk. The identification of the audit risk will give us half mark, and all of us will make sure today that we are going to explain the audit risk as well. And if we are going to explain the audit risk, we will get another half mark for that. So identification of audit risk will give us half mark, and explanation will give us another half mark. The examiner is going to say and provide auditor's response. Describe audit risk and explain the auditor's response. So what about auditor's response? One response will give 1 mark. One auditor's response will give us 1 mark. When you are going to read the solutions of the past paper, when you are going to go through your exam kit, you will find 3, 4, 2, 3, 4, 5 responses per audit risk. All those responses have been stated just to make sure that you realize that all these responses are correct on its own. But you don't have to write all those responses on your exam day. One valid response will give you 1 mark. So never try to idealize the past paper answers. The past paper answers are super duper ideal answers, and they are there to facilitate the learning as well. They are not meant to be 100% copied and paste. Okay, so don't come up with 4 responses. If you know 2 responses, write 1. At the end of the complete exam, if you still have got good enough time and there is no one to talk to on your right or left, and you need to kill the time, yes, go on, write 1 more response, go on, write more recommendations in the control section, go on, write more substantive procedures. But don't write more than 1 response when you are attempting the exam on the first go, because time management is the key to success. Okay, there are 2 possible exam questions. There are two types of exam questions when it comes to audit risk, and there is no major difference in it. Type 1, the examiner is going to come up with a scenario and the exam requirement will be the same, that is describe audit risk and explain the auditor's response. That's the type number 1. Type number 2 of the exam question is that examiner is going to give you a scenario plus an extract of the financial statements. And if the examiner is going to give you an extract of the financial statements, the examiner is definitely going to ask you to calculate few ratios as well. Those ratios are called analytical procedures, because those ratios will indicate potential areas of misstatement. Another knowledge base, you got to learn the definition of analytical procedures. What are analytical procedures? Analytical procedures are comparisons, trends, comparison of financial data with non-financial data, financial data with financial data. These analytical procedures reveal that there is a potential misstatement somewhere. Let me give you a quick example, then we can move on. Imagine the sales have gone up by 30%, but the distribution costs have gone down by 10%. Does it sound acceptable to you? How does that sound? The sales have gone up by 30%, but the distribution costs have gone down by 10%. Let me give you another example. The sales have gone up by 20%, but the cost of sales have remained static. Do you find it digestible? Is this acceptable to you? I really don't think so. Why I'm saying that? Because if the sales have gone up, I am expecting that the distribution cost will increase as well. If the sales have gone up, I'm expecting that administration costs will rise up. If the sales have gone up, generally speaking, the cost of sales will shoot up as well. So if there is any unusual thing going on that could reveal a potential material misstatement, I'm saying potential material misstatement. What does potential means here? It means that there is a possibility that the financial statements are materially misstated. Is this clear? Let me give you another example of analytical procedure. Please concentrate, because the example I'm going to quote right now will come up in your exam. I'm telling you, considering the COVID-19, considering the cash flow problems all over the world companies are facing, this is going to come up in your exam, mark my words. Imagine the current ratio has gone down from as compared to the last year. Imagine the quick ratio has gone down as well. So both the current and the quick ratio has gone down. Let's say from 5 to 2 and from 2.4 to 1.1. Both the current ratio and quick ratio have gone down, and the payables payment period have drastically increased. Now please concentrate. Both the current ratio and quick ratio have gone down, and the payables payment period has increased dramatically. What does that suggest overall? It suggests that the client is struggling with the cash flows. The client might be facing liquidity problems. Concentrate on my words. The client might be struggling with cash flow problems. The client might be facing liquidity problems. And if those liquidity problems are not fully disclosed or not fully managed by the company, and if they're not fully disclosed, this leads to a potential misstatement. Why I'm saying that? Because this is a going concern problem which needs a disclosure, and if the client has not fully disclosed that particular issue, that lack of disclosure will be considered as a material misstatement. So this is how these analytical procedures tend to reveal potential material misstatement. If that disclosure is not there, this is a material misstatement. Is this clear? So there are two possible exam questions. Number one, scenario only. Number two, scenario plus an extract of the financial statement, not the complete financial statements, but extract of it. Exam requirements is same in both cases, the type 1 and the type 2. The exam requirement is same, describe audit risk, but we can and we should use financial statement extracts in describing audit risk. If there is an financial statement extract, you got to use that financial statement extract. You got to use those ratios when you are explaining your audit risk. I will be demonstrating that today, don't worry. Okay, now comes the last part before we go on to the past paper question. How to describe audit risk and how to explain the auditor's response. Now the first question is how to describe audit risk. Now remember, the audit risk has got two types: risk of material misstatement and detection risk. So how to describe audit risk can be divided into two parts: how to describe risk of material misstatement and how to describe detection risk. And I am addressing how to describe audit risk / risk of material misstatement. So how to describe risk of material misstatement? Which financial statement items are at risk of material misstatement? First of all, you have to explain which financial statement items are at risk. So imagine there was a flood, and as a result of the flood, inventory got damaged. So if this is a story from the question, which financial statement items are at risk? First of all, inventory is at risk. What is the risk? The risk of overstatement, understatement. Considering inventory, because of the flood, inventory might be damaged. So there is a possibility or there is a risk that inventory in the financial statements would be overstated because of the flood. The NRV might have gone below the cost. And if you're following IS2, you have to value at lower of cost NRV. So when the NRV has gone down, inventory needs to be written off. So which financial statement item? Inventory. What's the risk? Overstatement or understatement? Overstatement, because client might not have written off the inventory. What's the other item which is at stake? The expenses, because the balancing figure needs to be written off in the profit or loss account. So at least inventory is at risk of overstatement. If you are going to correctly identify which financial statement items are at risk, and you are going to tell me it's the risk of overstatement or understatement, you are going to get half mark for that. I've stated overstated / understated / misstated. If there is something which could be overstated or understated, you don't have to write overstated / understated, you need to write misstated. Let me give you an example for that. I just gave you an example of inventory being overstated. Let me give you an example of understated. The client is not willing to provide provisions for the warranty claims. Which financial statement item is at risk? Provisions. What's the risk? Understated or overstated? Understated, because the client is not providing the provision. As a result, the provisions will be understated. Now let me give you one example for misstated. Let's say during the inventory count procedure, let's say during the stock count, the movement of goods were not stopped. So there were goods coming in the warehouse and going out of the warehouse. So there is a possibility that some of the items might be counted twice, or maybe some of the items were not counted altogether. What does that mean? Inventory is at risk. What's the risk? Overstated or understated? What's the risk? Well, I believe that some of the items might be counted twice. That makes inventory being overstated. But I also I'm also thinking that some of the items might be counted all together, which means that inventory might be understated as well. So inventory is at risk of misstatement. Rather than writing overstated / understated, I'm going to say misstated. But if I'm confident that inventory is at risk of overstated, I'm going to say inventory is at risk of overstatement because of the flood. If I'm confident that provisions are at risk of understatement because the finance director is not willing to provide the provision, I'm going to say provisions are at risk of understatement. Is this clear? Half mark. How we are going to score half mark? Which financial statement items are at risk of understated, overstated, or misstated? Is this clear? Okay. Now comes another half mark. How are we going to score another half mark? We are going to score another half mark if we are skeptic. Another thing for your knowledge base, you got to learn the definition of skeptic attitude. What's skepticism? A skeptic person is someone who does not believe in unquestioned honesty. I'm going to inquire and I'm not going to trust your explanation. I'm going to find corroborative evidence. I'm going to look for other evidence. I'm going to verify things. I'm going to look for other evidence. So if someone has got a habit of creating doubts in the mind, that's a positive attribute when it comes to audit profession. So when it comes to another half mark, you got to be skeptic. You got to think why client's accounting treatment is wrong or could be wrong. Now that's quite tricky. Why client's accounting treatment is wrong or could be wrong. There are two possibilities here. There is a possibility that the question states that the client has not recognized the impairment expense, although the flood has significantly damaged the property, plant and equipment, whatever. Now there is no doubt that the client's accounting treatment is wrong. So you are going to say non-current assets are at risk of overstatement because of the flood, because the client has not correctly impaired the non-current assets, although the non-current assets have been significantly damaged because of the flood, and their, let's say, recoverable amount is well below their carrying value, which leads to impairment expense. Now the client's accounting treatment is wrong. So you are not going to say there is a risk that the non-current assets are at risk of overstatement. You are not going to say there is a risk. You are going to be more categorical. You are going to be more authoritative, and you are going to say non-current assets are at risk of overstatement. Why? Because the client has not recognized the impairment expense, which is due to be recognized because of the flood. But there is a possibility that the examiner is going to say that there was a flood, that's it, and because of the flood the non-current assets have been damaged, that's it, full stop, end of the question. So examiner has not revealed whether the client has charged the impairment expense or not. How are you going to construct your answer? Non-current, there was a flood that damaged the property, plant, equipment of Ahmed Company Limited. Non-current assets are at risk of overstatement. Why? Now you have to express. There is a risk that client has not charged the relevant impairment expense, and there is a risk that their carrying value is greater than their recoverable amount, and as a result their non-current assets are overstated and their expenses are understated. Why I'm saying that expenses are understated? Because the relevant impairment expense had to be expensed out, but there is a risk that client didn't do that. So there is a variety, and your English skills, your vocabulary, your communication skills need to be very strong here. So if the client's accounting treatment is categorically wrong, you are going to say this is not correct in accordance with that standard, or this is not correct. But if the client's accounting treatment is judgmental, or the question has not revealed what's the correct accounting treatment or what actually client had performed, you are going to say there is a risk that. This is how you are going to explain. So I hope now you are clear how we are going to score 1 mark. Please note, if the client's accounting treatment is wrong, don't say there is a risk that, because surely that's wrong. So you are not going to say there is a risk that. You are only going to say there is a risk that when you are not sure what accounting treatment the client performed. So when you are being skeptic, you are going to say there is a risk that. But when you are confident about the client's incorrect accounting treatment, don't say there is a risk that. In fact, say this is not correct. Okay. How to describe audit risk, detection risk? Audit risk has got two types. Number one, risk of material misstatement, which is mostly tested in the exam. Number second, detection risk. I just told you how to get 1 mark for the sake of risk of material misstatement. Let's go and explore how to get 1 mark for the detection risk. How to describe audit risk, but which audit risk? The detection risk. By the way, detection risk does not frequently comes in the exam. If it is going to come in your exam, out of 8, 1 will be detection risk. Rest all of them will be risk of material misstatement. How to describe detection risk? There is a pattern, there is a science to describe detection risk. What is detection risk? Auditor might not be able to detect. That's the definition of detection risk. Auditor will be failed to detect. So how I'm going to explain detection risk? Auditor might not be able to detect the material misstatements in the financial statements because, and then you have to explain the reason. Because this is a new audit client which we are going to audit, and considering it's a new audit client, we definitely, or we might lack accumulated knowledge and experience of the client. So we might not be able to detect the material misstatements. Auditor might not be able, you don't say which financial statement items. That's the technique for the risk of material misstatement. Auditor might not be able to detect the material misstatements in the financial statement because this year's audit is extraordinary time pressured, and because of the extraordinary time pressure, we might not be able to, make sure the quality we need to make sure, or we might have to compromise on certain things, and as a result, we might come up with incorrect audit opinion. Auditor might not be able to detect the material misstatements in the financial statement because for this particular audit client, we lack resources. The deadlines are very fast approaching. There are not good enough resources. The key audit partner or the senior audit managers are on leave because of they are on sick leaves. So we don't have good enough resources to handle this particular client, and as a result, we might not be able to detect the material misstatements. Auditor might not be able to detect the material misstatements in the financial statements because we are not good enough when it comes to competence. This client has expanded itself into a new industry, and we are not good enough competent when it comes to that particular industry. So there is a possibility we might commit a mistake. Another example could be, which I have missed in this particular slide, you might write it somewhere for now. Auditor might not be able to detect the material misstatements in the financial statements because the client has outsourced its payroll to a third party. The client has outsourced its bookkeeping to a third party. So because the client has outsourced its service function to a third party, I might not be able to gather evidence from that third party. So this is another potential detection risk. Auditor might not be able to detect the material misstatement. Why? Because of the involvement of that third party, I might not be able to gather good enough evidence. So that is how you are going to describe audit risk. The last part, and then we go on to the past paper question, the last part. How to explain the auditor's response. Now we have covered 1 mark and we are left with 1 mark. How to explain the auditor's response. Remember, imagine in your mind there is a risk and you are foreseeing it, you are observing it, you are realizing it. You have to come up with some action. The reaction or the action that should be taken by the auditor against the risk in order to counter the risk, that's the auditor's response. So if the non-current assets are at risk of impairment because of the damage, what should be your response? I think you need to, have a discussion with the management. What's their assumptions and what's their point of view regarding the recoverable amount of the asset, and and what's their assumptions regarding the recoverable amount. So you need to have a discussion why they are not charging the impairment expense. That's your reaction, right? That comes in your mind, right? So that's your auditor's response. So if certain items of inventory are very old, aged inventory, so inventory might be overstated, what's your response? I think you need to have a discussion with the management that they need to write off those inventory. You need to have a discussion with the management that those items might not be having good enough NRV. So whatever the auditor's reaction against the risk, that is called the auditor's response. The response must be the response of the auditor. You have to think like the auditor. You don't have to think like the client. As an auditor, you should verify the risk through your response. You have to come up with an action that is going to address the audit risk. If this is clear, we need to start a question, past paper question. But before we go on to question, if there is any question from your side, please go on. Okay, let's start the questions. Would you recommend to read the book Saifur Rahman? Definitely, absolutely yes. Why not? If you are going to read the book, your OTQs will improve. If you are going to read the book, you will find chunks of knowledge base and you are going to type them somewhere, and you are going to create your own booklet, and that is how you are going to improve on your typing speed. And last but not the least, your knowledge base will improve as well. So all those factors combined, they suggest what? I think they suggest that you need to read the book, and you have got enough time for that. Arif has got the same question regarding the book reading, and I've answered already. Okay, Dan has asked. Okay, the ACCA team has answered your question. Could you explain projected misstatement again? Yes, okay, I will explain the projected misstatement again. Wait. Okay, what's the projected misstatement? Imagine the entire population is 100, but as an auditor you work on a sample basis, so you selected a sample of 10 out of 100. Out of that 10 which you selected as a sample and you worked on it, you found 2 to contain misstatement. There were 2 misstatements, 8 were correct. Now if 2 has got misstatement out of 10, what about the rest of the 90? I think if 2 has got misstatement out of 10, 2 divided by 10 multiplied by 100, I believe the overall misstatement is 20 out of 100. Now this misstatement of 20 out of 100 is a projected misstatement, because you are not 100% dead sure that there are 20 misstatements. You are projecting it. 2 are actual misstatements out of 10, but according to 2 out of 10, you are forecasting that there will be 20 out of 100. This is called projected misstatement. Now please tell me, are you clear with the projected misstatement now? Tanishka, you asked this, please do let me know if you are clear. Okay, sir, can you please repeat inherent risk? Atar has asked, can I repeat inherent risk? If the control system is weak, I'm going to answer in a very different way. Please concentrate, Mr. Atar. If the control system is weak, as a result, financial statements will be materially misstated. Do you agree with this? Controls are weak, frauds will be there, errors will be there, financial statements will be materially misstated. Now, because of the poor control system, the financial statements will have material misstatement. This is a control risk leading to risk of material misstatement. This is a control risk leading to material misstatements in the financial statements. But just imagine there is a reason behind a material misstatement which has got nothing to do with the controls. Imagine there is an extraordinary pressure on the employees. There is nothing to do with the controls. Imagine the employees are not competent. Imagine the recruitment of the employees on the basis of references. The culture of bribe is there. Imagine the culture of bribe is there. So if these are the cultures, bribe, discrimination, references, extraordinary workload, the control system has got nothing to do with the misstatement. All those factors are called inherent risk, and they contribute to what? They contribute to one thing, which is called the risk of material misstatement. All these factors will lead to material misstatements. Is this clear? I hope it is clear. Okay, Ankita has asked, can we refer to Kaplan June 21 book and kit, or the latest September version is available now? For now, you can refer to 21 book because there is no major change in the syllabus. But as far as the latest September 2021 attempt book is concerned, I will try to get it for you and I will share in the WhatsApp group, which I'm going to make in a while. Wait, hold on, don't worry. Okay. What is the difference between auditor's response and substantive procedure? Substantive procedure is an action, whereas auditor's response is a plan that we are going to do this. You will find this, you will find the clarity after 2-3 days. So hold on. I will give the break. Hold on. Dear sir, is there any article on changes in the syllabus? Mr. Azhar, my beloved Mr. Azhar, there is no article as yet. If there will be an article, I will share in the WhatsApp group. More importantly, I don't think so there is a need for article. Why I'm saying that? Because there are no major changes. So you got to concentrate on risk, controls, procedures, OTQs, knowledge base. Don't think about changes. Forget changes. Okay, is it correct? The higher the control risk, the lower the detection risk. If the inherent risk and control risk are on the higher side, you got to, as an auditor, you got to lower down the detection risk. Automatically, it's not lower down. As an auditor, you got to increase the sample size. You need to be, you need to increase the sample size, more skeptic, more audit team, more understanding, more work. You got to reduce the detection risk in order to overall reduce the audit risk. If the inherent and control risk, that is the risk of material misstatement, is on the lower side, you don't have to work a lot on your detection risk. I hope it is clear now. Sir, can auditor's response be a test of control or a substantive procedures? Don't say that. It's too quick to say that. Wait for a few days. Okay, what if I'm not sure of mentioning the financial statement item overstated or understated? Can I mention as misstated? No. You have to state which financial statement item, and you have to state overstated or understated. If you are not sure, you can use misstated, but that's not recommended. The recommended is you have to mention which item is overstated, which item is understated. You will be able to figure out which is overstated, which is understated. Can you repeat non-sampling risk? Laiba is asking, can you repeat non-sampling risk? Sampling risk means the sample is not truly representing the population. So you selected a sample, you figured out things are all right, but things were not all right, but your sample was all right. So the sample was not truly representing the entire population. That's sampling risk. What's non-sampling risk? Your sample was truly representing the population, but as an auditor, you made a wrong judgment. You applied wrong procedures. You draw a wrong conclusion. So that's non-sampling risk. Is there any chance we get only financial statement extract for audit risk question? No. Financial statements will be a part of the overall story. So financial statement, 100% financial statements and no story whatsoever. No, you are not going to get such question. Though financial statements are easier to handle. Is it mandatory to mention what is inherent risk and what is detection risk? No, it's not mandatory. It's not mandatory. How to deal with sampling risk? Okay, there is a question from Adil. How to address or how to deal with sampling risk? There is one simple solution. How to address sampling risk? Increase the sample size. Make sure your sample is haphazard. It's unpredictable. That is how you are going to address sampling risk. Can you please explain the 3 types of misstatement again? There are 3 types of misstatements. Number 1, factual, which are beyond the shadow of doubt, crystal clear misstatement, no doubt about it. Number 2, judgmental misstatement. Your point of view might be different from the client might be correct as well. Judgmental misstatement. Number third, projected misstatement, which I just explained, that a certain population is tested, and on the basis of that result you tend to apply those results on the entire population. That's projected misstatement. If a mix of two items for financial statement separate, how mix of repairs and enhancement expire. Okay, we'll address, Rian, such questions will be addressed in the questions. Factual misstatements are beyond the doubt, such as you have not charged the impairment expense although you had to charge. So this is beyond the doubt, crystal clear misstatement. Mavish has asked, can understand, please repeat the words. If not, accounting treatment wrong, clear by examiner. We know is the word, there is a risk. Repeat it. If the client's accounting treatment is not wrong, you are going to say this is not correct. This is not in compliance with IAS 38, whatever the accounting standard. This is not correct. They had to write it off, but they haven't. So this is not correct. You are going to use such wording. But if the client's accounting treatment is not clear, you are going to say there is a risk that the client's accounting treatment could be wrong. So this is the difference, Mavish. No new article. Are you going to give us assignments and review them? Yes, I will try to give you assignment, but I will be able to review after the webinars. Can you give a brief explanation of that accounting treatment? Yes, I'm going to give you explanation, Mars, but in the question, don't worry. Furkan, you are absolutely right. You selected a sample of 10. There were no misstatements, so you said the whole population is absolutely clear, but there were misstatements in the other part of the population. This is called sampling risk. Yes. Okay, last question for the day. Yes, Ashwin, that is possible, but after the webinar. Okay, last question for now. Last question. Maruk has asked how to make OTQ stronger. You have to attempt 6 OTQs per day, and you have to address those OTQs by reading out the solutions as well. You should be crystal clear why option 1 is correct, why option 2 is not correct. So you have to spend quality time on the solution as well. Okay, one last question. Mr. Sarosh has asked, what is interim audit? Sarosh, if your client is a big one, huge one, and you cannot handle that client as the final audit, you cannot handle the whole audit at the end of the day, you might come up with interim audit. You might cover the half yearly audit, half financial statements at the mid-year point. That's called interim audit. So what's the benefit of interim audit? When you are going to come up with the final audit, you have already covered certain portion of it. So that's called interim audit. It's not mandatory, it's not obligatory for the audit firms, but audit firms tend to apply interim audit just for the sake of their own convenience, so that at the end of the final audit, their work is divided. What is the difference between audit risk and business risk? Business risk is not examinable in F8, in audit and assurance exam. It is examinable in P7. What is business risk? That the business might not be able to achieve its objectives. You're not supposed to write about the business. What is audit risk? Auditor might not be able to express correct opinion. So you have to focus on audit risk. It's not mandatory to consider internal controls only when it comes to interim audit, but yes, you are going to focus on internal control as well. But when it comes to interim audit, you are going to focus on the financial statement as well, and you are going to have a cutoff that this is the point till when we have audited, and when you are going to come up for the final audit, you are going to start from that particular point. Okay, that's it for now. Let's start the question. Let's start. Okay, let's start the questions, and after this question we'll have a break. Okay, so let's solve this question, then we'll have a break. Let's straight away go to the requirement. Part A, describe the audit firm's responsibilities in relation to the prevention and detection of fraud and error. This is again a knowledge based question. You have to describe the audit firm's responsibilities in relation to the prevention and detection of fraud and error. You got to read the solution, you got to understand the solution, and you got to type the solution, you got to learn it. That's it. This particular 4 mark has got to do nothing with your question. So what is your responsibility regarding the fraud and error, or for that matter prevention and detection of fraud? As an audit firm, you have to audit in accordance with ISA 240, which is the auditor's responsibilities relating to fraud in an audit of financial statements. And you got to make sure that the financial statements as a whole are free from material misstatements. What are the causes of material misstatements? 2 causes: fraud or error. So you have to make sure as an auditor that the financial statements as a whole are free from material misstatements. So in order to fulfill this responsibility, you got to identify the risk of material misstatement, whether this risk of material misstatement is due to fraud or error. You need to obtain sufficient appropriate audit evidence that any material misstatement, whether due to fraud, have been identified. And for that, you need to come up with auditors' responses. You need to design and implement the auditors' responses so that you can identify the incidents of frauds and incidents of errors. And in order to address this particular responsibility, you need to maintain what? Professional skepticism. This is again knowledge based. You need to make sure that you understand the client's controls. You need to make sure that you remain skeptic throughout the audit. So this is a knowledge based question. You got to learn it. If you're unable to cover all that, you can skip the last part or the last paragraph, but at least this one. So this is a confirmed knowledge base. This is tested quite oftenly. What is the auditor's responsibilities regarding the fraud? So let me summarize this one for you. As an auditor, this is our responsibility to audit in accordance with ISA 240, and that standard says that we need to make sure that the financial statements are free from material misstatement. The financial statement should be free from material misstatement, whether those material misstatements are caused by fraud or error. And as an auditor, we got to make sure that we design good enough procedures, we implement good enough procedures just to make sure that all frauds are identified. And for that, we have to make sure that we remain skeptic. We have to make sure that we consider the controls. We need to make sure that we establish a good enough team just to make sure that the incidents of frauds and errors are identified. So this is a knowledge base, and it has got nothing to do with the question. So we are solving a question which is called BlackBerry. This question is from recent past papers. This question is available in your kits as well, both kits. Let's go to part B. Describe 8 audit risks and explain the auditor's response to each risk in planning the audit of BlackBerry company. So this question has got no financial statement extract in it. You have to explain 8 audit risks. How much marks you are going to get? 8 audit risk. The explanation, description of 8 audit risk will give you 8 marks, and the auditor's response will give you another 8 marks, and overall this gives you what? 16 marks. So 4 plus 16, that gives you 20 marks. That's it. End of the question. So the next question I'm going to cover has got financial statement extract in it, which we are going to cover after the break. Okay, so let's recall the technique. Describe 8 audit risk. If the risk of material misstatement is there, which financial statement item, understated or overstated, and then we have to explain why as an auditor we think that the client's accounting treatment is wrong or could be wrong. And then we have to explain the auditor's response. Let's start reading the question. You are an audit senior of the audit firm and you are planning the audit of BlackBerry company for the year ending 31st March 2018. The company is a manufacturer of portable music players and your audit manager has already had a planning meeting with the finance director. Forecast revenue is this and profit is this. She has provided you with the following notes of the meeting. In the first paragraph, I found no audit risk. Generally, there is an audit risk in the first paragraph, and that is sometimes the audit client is a new audit client. If the audit client is a new audit client, that becomes what? That becomes detection risk. Auditor might not be able to detect the material misstatement in the financial statement because this is a new audit client, and considering it's a new client, we lack accumulated knowledge and experience of that particular client. So we might not be able to figure out things. What should be the auditor's response? We need to devote more time on planning. We need to remain more skeptic. We need to devote more experienced staff to that particular client. But unfortunately, this is not tested here in this question. Let's go back to the question. So till now, I have not identified any audit risk. Okay, let's start the question. Planning meeting notes. Inventory is valued at lower of cost and NRV. We all know that International Accounting Standard 2 states that inventory should be valued at lower of cost and NRV. Cost is made up of the purchase price of raw material. That's correct. Cost of conversion, that sounds correct as well, including labor, that's correct, production and overheads. Now, being skeptic at it, being a manager, being an auditor with skeptic attitude, I've got a doubt in my mind. What's the doubt? BlackBerry company values its inventory at lower of cost and NRV. That's all right. But still inventory might be overstated. I'm using the word might be, because inventory is at risk of overstatement. Why I'm saying inventory is at risk of overstatement? Which financial statement item? Inventory. What's the risk? Overstatement, understatement? Overstatement. Why I'm saying that? Because there is a risk that these general overheads are not all relevant to production, and in accordance with IS2, non-production overheads cannot be part of the cost of inventory. What does the International Accounting Standard 2 states? You got to value the inventory at full production cost. No non-production item can be part of the valuation of the inventory. So inventory is at risk of overstatement. Why? Because the client values at its inventory at the lower of cost NRV, but the cost is made up of purchase price of raw material, cost of conversion, including labor, production, and general overheads. There is a risk that general overheads incorporates items which are not relevant to production, and as a result, inventory would be overstated. If you want to copy certain chunks of the question to your exam answer platform, you are allowed to do that. A student can come up with what a student can do. Inventory is valued at lower of cost NRV. Cost is made up of the purchase price of the raw material, cost of conversion, including labor, production, and general overheads. A student can copy all that from the question, from inventory is valued to general overheads. Then a student is going to start answering. Inventory is at risk of overstatement because there is a risk that general overheads have got certain items which are not relevant to production, and that therefore does not meet the criteria of International Accounting Standard 2. That's it. You are going to get complete 1 mark for that. There is a risk that general overheads have got certain items which are not relevant to production, and therefore this is the non-compliance of IAS2 inventory. How does that sound? 1 complete mark. What should be the auditor's response? If this is a risk, you're not 100% sure that general overheads are made up of all production related items, or there are certain non-production items in it. So what should be your response? What should be your action? I think my response should be that I need to have a discussion with the management regarding the general overheads, and I need to inquire that what items they have incorporated in the general overheads, And if there are non-production items in the general overheads, I need to request the management that they need to remove those items. Is this clear? Is this clear? What should be the response? I need to have a discussion with the management regarding the nature of the general overheads, not about everything else. I need to have a discussion with the management regarding the general overheads, and I need to explain them that if there are non-production items in the general overheads, they need to get rid of them because that does not meet the criteria. That's it. You are going to get 1 complete mark for that. Another response could be another, I repeat, another, that's not required for 1 mark. Another response could be you can review the supporting documents relevant to the cost of inventory in order to verify that there are no non-production items in it. That could be another response. But if you're comfortable with the first response, you don't have to think and write the next response. Okay, let's continue the question. Let's stay aggressive because we are running short of time. Remember, you have to attend the webinar till then because I've got 1 more question up in my sleeve, and I have promised myself that consecutively throughout the 5 days I will be addressing at least 3 OTQs per day, because that's a common reason of failure I have figured out in the last 2 sessions. If a student has covered his OTQs, the student is going to pass the exam. Inventory is held in 3 warehouses across the country. So there are 3 warehouses. Okay, fine. The company plans to conduct full inventory counts at the warehouses on 2nd, 3rd, and 4th April, and necessary adjustments will be made to reflect post-year-end movements of inventory. The internal audit team will attend the counts. There is a problem. There is a problem. The company plans to conduct full inventory counts, but unfortunately, the counts will be on 2nd, 3rd, and 4th April rather than on one particular date. And as a result of 3 different dates, as a result of 3 different days, there will be movement of goods. Certain movement of goods on 2nd, certain movement of goods on 3rd, certain movement of goods on 4th. And as a result, there will be certain adjustments required. And if there are certain adjustments required, are you dead sure that those adjustments will be absolutely crystal clear by the management? Are you dead sure that those adjustments will not have any material misstatements in them? Are you dead sure that those adjustments will be free from material misstatements? No, you are not sure. And as an auditor having skeptic attitude, you should doubt. So which financial statement items? After copying all that from the question, which financial statement item? Again, inventory. What's the risk? Overstatement or understatement? Can you answer me? What's the risk? Understatement, overstatement? Yes, the risk is misstatement, Navneet. Well done. Why I'm saying that? Well done, Mavish. The risk is misstatement. Yes, absolutely right, Hira. Why I'm saying that? Because there is a possibility some of the items have been counted twice, or some of the items have been omitted altogether. So well done. All of you are doing great. Inventory is at risk of misstatement because there is a risk that those post year end adjustments are not correctly performed by the client. I've got doubt. My attitude is skeptic. So there is a risk those adjustments are not correctly performed by the client. Yes, Saifur Rahman, you are absolutely right. So what should be your auditor's response? You have scored 1 mark. What should be your response? First of all, you need to make sure that you also attend the inventory count, and you need to make sure that you note down all the good dispatch and the good receive notes during that particular period of 2nd, 3rd, and 4th April, so that at the end of the day, when client comes up with all those adjustments, you can reconcile those adjustments by yourself. So during the inventory count, if there is a movement of goods going on, as an auditor, you should plan to attend the inventory count, and you should try to make sure that you note down all those movement of goods, whether it is good dispatch note, whether it is good receive note, so that at the end of the day, you can perform the reconciliation on your own, and you can figure out whether those adjustments are now correct or not. What's the risk? The adjustments are not correct, or might be not, or might be wrong. What should be your response? You got to perform the reconciliation by yourself. Is this clear? Okay, Mr. Ahmed is saying auditor can so recalculate the inventory value to verify the value. No, 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 no. This is not a correct response. The risk is that those adjustments might not be correct. You are trying to calculate the value of inventory. Your response is not in accordance with the risk. Dear students, other than Ahmed Hafiz, the risk is those adjustments might not be correct by the client. So your response should be about the adjustment. Ahmed is saying we need to recalculate the inventory value. So that's not correct response. Mr. Ashwin is saying that the inventory is held at 3 warehouses. The 3 warehouses leads to 3 different dates of stock count, and that creates a risk. The 3 warehouses itself does not create a risk, Ashwin, because normally speaking, clients do not have one warehouse. So having multiple warehouses does not create a risk, but having different dates, having those adjustments made, that creates an audit risk. That creates because of the adjustments, that creates a risk. No, Ashwin, that does not create a risk on its own. Those adjustments create a risk. Okay, let's continue. Let's continue the question. Oh, by the way, one has to count how many audit risks we have identified so far. First one was inventory valuation because of the non-production items. Second one was again was the inventory could be misstated because of the adjustments. So 2. So we have attempted 4 mark paper out of the 16. Let's continue. During the year, the company paid 1.1 million to purchase a patent which allows the company the exclusive right for 3 years to customize their portable music players to gain a competitive advantage in their industry. So this is about IAS 38 intangible assets. The intangible has got a useful life of 3 years. But what does the client did? The company has expensed 1.1 million in the current year statement of profit or loss. Oh, is this correct accounting treatment? Someone with the grip on IAS 38, is this correct accounting treatment? The company purchased an intangible asset having useful life of 3 years, costing 1.1 million, but they have not capitalized this as an intangible asset. They have not amortized it over the period of 3 years, and they have expensed it altogether in the current period's profit or loss. Is this correct accounting period? From Sonam, Varda, Mavish, Sir, Ahmed, Sarosh, absolutely right. Sarosh, yes, they should have added to the non-current assets, to be precise, intangible assets. Well done. All of you, Rhea, all of you are absolutely right. This is not the correct accounting treatment. Now, dear students, please take a deep breath and take a moment. How am I going to write this answer? First of all, let me give you an example of wrong answer. Concentrate. I'm going to copy this. During the year, BlackBerry company purchased 1.1 billion to gain a competitive advantage in industry. This has been expensed in the current year statement of profit loss. So I copied all that from the question just to make it convenient. If it is not mandatory to copy all that, if you don't wish to copy, you can skip it. Okay. Now how do I write the answer? Intangible non-current assets are at intangible non-current assets. I'm going to write a wrong answer. Intangible non-current assets are at risk of understatement because there is a risk that, now this is a wrong answer. This is a wrong answer. Why this is a wrong answer? The correct answer should have been management has expensed the full amount in the current year's statement of profit or loss, and this is not in compliance with IAS 38. Intangible non-current assets are understated and expenses are overstated. You don't have to write there is a risk that. You have to be more authoritative. You have to be more categorical. You have to make sure that you write with confidence that this is not correct in accordance with IAS 38. This needs to be capitalized as an intangible asset and then charged and then amortized over the useful life of 3 years. This is the correct answer. How does that sound? Are you confident now how to write the answer now? How are you going to write? intangible non-current assets are understated and expenses are overstated. Why? Because the client should have recognized this as an intangible asset and amortize over the period of 3 years. This is the client's accounting treatment is not correct in accordance with IS 38. That should have scored 1 mark. Is this clear? Can I have a yes from you? Can I have a yes from you? Thank you, Emma. Thank you, Ashwin. Thank you, Sarosh. Thank you, Hira. Fantastic. With your yes, I feel a lot more confident. Now, what should be your response? I think the first response which comes in my mind, I want to have a discussion with the management. What's up, guys? What are you doing? What are you doing and why are you doing? So you need to have a discussion with the management, and you need to understand their point of view behind the written off of this 1.1 million. You need to make sure if they have now performed the correct accounting treatment, you have to make sure that they have correctly charged the amortization expense and they have fully disclosed everything. So that should be your response. You need to have a discussion with the management, and you need to make sure, first of all, you need to understand what's up, what's going on, why this is going on, what's their point of view, why they are doing it. So this is a valid response. This will give you 1 mark. I'm not going onto the solution. If I'm going to go on to the solution, this will cause more time, but we'll go through the solution at the end of it. The 1.1 million. Okay. In order to finance this purchase, of 1.1 million patent, the company raised 1.2 million through issuing shares at a premium. When I was going through the questions earlier, somebody asked me about the split of certain things. I don't remember the name, I'm sorry, but somebody asked me about split. Now there are certain splits. Please concentrate. This is an extremely important moment. If your client has raised 1.2 million through issuing shares, there is a risk that the client has not correctly split this 1.2 million into share capital and share premium. By the way, the nominal value goes to the share capital and the rest of the amount goes to the share premium account. There is a risk that the client has not correctly accounted for the share capital and share premium, and client has not fully disclosed this share capital and share premium. So which financial statement items are at risk? The equity capital. What's the risk? There is a risk that client has not made the correct accounting treatment with respect to this 1.2 million by not correctly accounting for the share capital and share premium account and by not disclosing it in full detail. What should be your response? What should be your response? I think you need to review the accounting treatment and you need to confirm that the client has correctly split this 1.2 million into share capital and share premium. Moreover, I think you need to make sure that you review the bank statement in order to make sure that client actually received 1.2 million. That's a risk as well. The client is saying we raised 1.2 million. What if they didn't? So you need to review the bank statement in order to verify actually 1.2 million was received and the correct accounting treatment prevailed by making sure that the nominal amount was credited by through the share capital account and the rest of the money was credited in the share premium account. And you can also review the disclosures just to make sure that they have fully disclosed the accounting treatment of this. Now somebody asked me a question about the split of things. Okay, now I'm going to deviate from this question. Please concentrate. I'm going to deviate from this question. Please concentrate. If the client has spent a certain amount on refurbishment, remember the refurbishment has got 2 things in it, the capital expenditure and the revenue expenditure. There is a risk that the client has made a refurbishment of, let's say, 5 million, and they have not correctly classified that 5 million into capital and revenue expenditure. So there is a risk that the capital expenditure, the split of revenue expenditure and capital expenditure is not correct, and as a result non-current assets will be misstated. Certain items needs to be expensed out but the client has capitalized, certain items need to be capitalized but the client has expensed out. So if there is an expenditure or refurbishment, there is always a risk that the capital and revenue expenditure is not correctly split into into their respective categories. If client has raised certain amount from the loan, there is a risk that the client has not correctly split that particular loan into non-current and current liability, because loans generally need to be divided into two portions, the current liabilities and the non-current liabilities. So there is a risk that the current and non-current liability, the associated finance cost and the associated disclosures are not correct. How does that sound? I have told you, I have expressed this 1.2 million into share capital and share premium. Similarly, this 1.2 million can be divided into capital expenditure and revenue expenditure. Similarly, this 1.2 million can be divided into non-current liability and non-current liability. How does that sound? Are you sure and are you confident now? Can I have a yes? Can I have a yes through which I feel confident that you are clear? Obviously, the exam question could be different. Thank you, Zulkarnain Heather. I'm loving it. Thank you very much. Thank you. Thank you, Praveena. Thank you, Tanishka. Thank you very much. That's great. Confident. Thank you. Same here. Thank you, Ajwa. Okay. Let's continue the question. In November 2017, it was discovered that a significant teaming and leading fraud had been carried out by 4 members of the receivable ledger department who had colluded. So they were a team. They had stolen funds from wholesale customer receipts, and then to cover this, they allocated later customer receipts against the older receivables. That's what teaming and leading fraud is. You are not going to recognize the payment received from Mr. A. When you are going to receive payment from Mr. B, you are going to allocate it to Mr. A, and you are going to skip that one payment and you are going to fill up in your own pocket. That's what the teaming and leading fraud is. These employees were all reported to the police and subsequently dismissed. Okay, I'm done. Here is an audit risk. What if the full potential, what if the full impact of this teaming and leading fraud has not been discovered as yet? What if there is a risk that the full impact of the fraud has not been completely identified or quantified, and as a result there are many more fraudulent transactions which are yet to be discovered? As a result, there is a risk that financial statements could be materially misstated. As a result, receivables could be overstated. As a result, relevant expenses could be understated. Are you clear with the risk? Considering there was a significant teaming and leading fraud, what if those fraud has not been fully identified or quantified as yet, and because of those fraudulent transactions, there is a possibility that certain items of fraud have not been quantified or identified as of now, and as a result, certain parts of the financial statement items are still materially misstated. What should be your response now? First of all, I think the greatest response should be that I need to make sure that my audit team should remain extraordinarily professionally skeptic throughout the audit, because there is a real actual fraud going on. So we need to be on our toes. We need to be very active. Specifically, we need to make sure that we increase our substantive testing when it comes to receivables, because the fraud has got to do with the receivables. So that's what a valid response is. Is this clear? Let's continue. As a result of the vacancies in the receivable ledger department, the company decided to outsource its receivable ledger processing to an external service organization. The service organization handles all elements of the receivable ledger cycle, including sales invoicing, purchasing, invoicing, chasing of receivable balance, and sends monthly reports to the BlackBerry company detailing the sales and receivables amount. BlackBerry company ran its own receivable ledger until 31st January 2018, at which point the records were transferred to the service organization. All of you have got 1 minute. All of you have got 1 minute. Please read this whole story all over again. There is one risk of material misstatement in it, and there is one detection risk in it. You have got 1 minute to read all the story again. There is one detection risk and one risk of material misstatement. Third party involvement. A service organization out of nowhere jumps between the auditor and the client. What happens then? First of all, the detection risk. Auditor might not be able to detect the material misstatements in the financial statements, specifically when it comes to receivable ledger. Why? Because during the year, the client outsourced its receivable to a service provider. Now, there is a risk that auditor might not be able to gather sufficient and appropriate evidence in order to confirm the completeness and accuracy of the receivable balance, because there is a third party in it, because there is an involvement of third party. It is difficult to gather evidence from the third party. You have got no direct communication with the third party. You are not the auditor of that third party. So this is the detection risk. See how I'm constructing the answer. Auditor might not be able to gather sufficient appropriate audit evidence, and that leads to detection risk. Why? Because during the audit, client has outsourced its receivable ledger to a third party, and auditor might not be able to gather sufficient appropriate evidence, and as a result, the completeness and accuracy of the receivable ledger balance might not be verified. What should be your response? I think you need to consider whether you need to contact that service provider and the auditor of that service provider in order to make sure that the controls which are in place at the third party are sound and effective. So that should be your response. You need to consider communication with the third party's auditor in order to make sure that the controls which are designed and implemented at that third party are effective. Is this clear? So that's the detection risk. Now, what about the risk of material misstatement in it? The question states that the data was transferred. That's the hint. Now you have to identify what's the risk of material misstatement here. I'm giving you 30 seconds. The data was transferred during the year. That's the hint. Which financial statement items? Receivables could be misstated. I'm not saying overstated, I'm not saying understated. Why? Because the data was transferred during the year, that is on 1st February to be precise, until 3rd January they kept their own record. The year end is what? March. So for a certain point of time they maintained their own record. So the receivables could be misstated because at the time the data was transferred, there is a possibility that certain errors were committed during the transferring of data, and as a result the receivables could be misstated. What should be your response? I think you need to have a discussion with the management and try to understand what controls were in place when the data was transferred in order to make sure that the process of transferring the data was complete and accurate. Is this clear now? Is this whole story relevant to this service organization clear? There is a detection risk here that you might not be able to gather evidence, and there is a risk of material misstatement because of the transfer of data. Receivables could be misstated. Is this clear? Is this clear? Can I have yes? Yes. Kelavani, you're right. Yes, Seth, you are right. Some data could be missing. Yes, sir, you are right. You are right. Some items could be missing. Thank you. Absolutely. And let me tell you one thing. Yes, while transferring the data, they might face yes, material misstatement. Yes, Hira, you're right. Let me tell you, that was the most difficult part of the question, that third party involvement. Let's cruise now. In December 2017, the financial accountant of the client was dismissed. The financial accountant of the client was dismissed by the client itself. He had been employed by the company for 9 years. Oh, and he has threatened to sue the company for unfair dismissal. As a result of this dismissal, and until his replacement commences work in the April, the financial accountant's responsibilities have been adequately allocated to other members of the finance department. Adequately allocated means no problem with the quality of work. Okay, what's the risk here? Any risk, especially that dismissal, especially that claim. I'm giving you an hint. Can I have the answer? Which financial statement item are at risk? Can you answer me? Well done, well done. Provisions against the unfair dismissals could be understated or omitted altogether. So provisions could be understated. Provisions could be understated. Why? Because there is a possibility. No, Maruf, there is a risk, because the financial accountant is suing the company. What if your client has not recognized a provision, or what if the client has not disclosed a contingent liability? Now IS 37 says if the payment is probable, you need to recognize a provision, and if the compensation payment is possible, you need to at least disclose. What if that compensation payment to that particular employee is probable, so the provision is understated? What if that compensation payment is at least possible, so the disclosure of the contingent liability, if that is omitted, all this is a risk. There is a risk. I'm not sure what's the client's accounting treatment. I'm not sure whether the client has recognized it or not. There is a risk that provisions are understated, or the contingent liability is not disclosed or not adequately disclosed. So which financial statement item? Provisions or the contingent liabilities might be understated or omitted altogether. Why? Because there is a risk client has not recognized it. What should be your response? Your response should be that you might need to have a discussion with the lawyer of the client and try to figure out what is the chances of that claim being successful. And if the lawyer says so, that the chances are there, you need to request the management that they need to recognize the provision, and or if this is possible, you need to discuss request the management that they need to disclose it as a contingent liability. Is this Ahmed Hafiz? Well done. If this is clear, please can I have a yes? Fantastic. Okay. However sounds very tricky to me. However, now I'm worried. I am guessing there is an audit risk coming up. However, for this period, no supplier statement reconciliations or payable ledger control account reconciliations have been performed. Considering no supplier statement or payable ledger control account reconciliations have been performed in this particular period, I believe this is a significant control deficiency. You guys tell me whether supplier statement reconciliations are part of the good control system. Yes, it is part of the good control system. But if that particular control system is not implemented for a particular period, that lack of control creates control risk. And I told you earlier, if controls are poor, as a result, the financial statements tend to be materially misstated. If a control is altogether omitted, the material misstatements in the financial statements, whether due to fraud or due to error, will be there. So considering the fact that this key control is overridden for a particular period, there is a huge risk that the trade payables at the year end could be what? Overstated, understated? I'm not sure. That is why I'm going to say misstated. Is this clear? What is the audit risk? Considering the fact this key control is missing for a particular period, there is a risk that the trade payables at the year end could be misstated. Why? Because for a particular period, no supplier statement reconciliations were performed. How does that sound for 1 mark? What should be your response? I think you got to request the management that they need to perform that reconciliation. And as an auditor, we should review that reconciliation. And if there are certain unreconciling items or unusual items, you got to get further evidence on that. You got to work more on that. If there are any unreconciling items or if there are any unusual items, you got to focus on that. First of all, request the management to perform the reconciliation. And if there is any unusual item or if there is any unreconciling item or unusual reconciliations, you got to focus on that. Is this clear? Can I have another yes, please? Yes, Maruk, you're right. Yes, Muhammad Ali, you're right. Yes, Somya, you're right. Yes, Mububi, you're right. Yes, Zulkarnain, you're right. Absolutely, Sonam, you're right. Ajwa, you're right. All of you, well done. Okay, let's go to the last paragraph. Finally, in January 2017, a receivable balance of 0.9 million was written off by the company so as it was deemed irrecoverable. So the client has already written off 0.9 million because it was irrecoverable. Fantastic. That's the way of doing it. Client has written off 0.9 million because that particular customer had declared itself bankrupt. So the client has written off 0.9 million. That's correct. That's correct. Move on. But what happens then? Next month, the liquidators of that particular customer contacted the company and they told the company that there is a chance. They announced publicly. No, not they. They did not contact the client directly. They announced publicly that there is a chance that the creditors will get 40% of the balance. So now use the calculator. What's the 40% of 0.9 million? What's the 40% of 0.9 million? Oh, that is available in the question as well. As a result, the company has included a current asset of 360,000 within the statement of financial position and other income in the statement of profit or loss. Is this correct accounting treatment? Ahmed, you're right. Subhaiba, you're right. Now my question is this correct accounting treatment? Mavish, you're absolutely wrong. Ahmed, you're wrong. Ajwa, you're wrong. You're right. You're right. The client's accounting treatment is wrong. You guys are right. The client's accounting treatment is wrong. Now, please, if somebody has not understood or if somebody believes that the speed of my question is too fast, let me be a bit slow for that last particular moment. There was a receivable balance recognized in my current asset, my receivable balance of 0.9 million. But my debtor, I'm the client, you are the auditor. But my client declared itself bankrupt. So what did the client do? The client has written off that receivable, charged it in the profit or loss as an expense. After a month or so, the client realizes that there is a chance of 40% payment. So client has now again recognized 360,000, that is the 40% of 0.9 million, as a current asset, and again has recognized income, the reversal of that particular expense. Is this a correct accounting treatment? This is not a correct accounting treatment, and you are not going to say there is a risk that, because there is not a risk. This is not correct. This is not correct. IAS 37 provisions, contingent liabilities and contingent assets states that only those assets need to be recognized which are virtually certain, and this 40% payment is not virtually certain. The payment is probable. If it is probable, you need to disclose it as a contingent asset, and if it is possible, I think this is only possible, not even probable, you have to ignore it altogether. So the year end receivable balance is overstated. Why? Because the recognition of 360,000 does not meet the criteria of IAS 37. Considering this is not a virtually certain asset, you are not, this accounting treatment, this recognition of 360,000 is not correct. What should be your auditor's response? You need to have a discussion with the management and you need to make them understand that considering it is only possible, this cannot be recognized, and they need to write it off. If it is probable, you got to make sure that client fully discloses it. Even then it cannot be recognized as an asset. Is this clear? Can I have a yes? Yes, Adil, you are right. This is not this is an incorrect accounting treatment. You are absolutely right. Maruk, you're right. Maruk, you're right. Detailed post year and cash receipt testing should be performed. Yes, this could be a response, but before that you need to ask the client that they need to write it off. If they are going to receive the cash somewhere in the future, that's a separate story. But for now, at the year end, Maruk, your response should be that you need to ask the management, please write it off, because they have already recognized it. Only a disclosure is required only if it is probable. If it is only possible, then nothing is required. Thank you, Navneet. It is inevitable to name the standard in the explanation. How to improve identification of risk, sir? Sarosh, if you are going to attempt 3-4 questions, which I'm going to recommend today, automatically you will be a quality student. Trust me on that. Okay, last question for now. Mr. Ali has asked, is it mandatory to mention the question, or is it evitable? Can you avoid it? There are only 6-7 accounting standards which are tested in the AA exam. Let me name them. If you want to write somewhere, you can. You got to be familiar with International Accounting Standard 2 inventory, International Accounting Standard 10 events after reporting period, adjusting, non-adjusting, IS 16 property plant equipment, depreciation, carrying value, recoverable amount, revaluation model, cost model, IS 16, IS 36 impairment, IS 37 provision, IS 38 intangible assets. That's it. Okay, let me be slow. My bad. I'm sorry. I'm going to repeat all over again. Oh, forget about the spelling mistake. But I hope that even if there is a spelling mistake, it makes sense. Okay, let me repeat the accounting standards all over again. Write it in code words, guys. IAS 2 inventory, IAS 10 events after reporting period, IAS 10 for now, IAS 10, IAS 2, IAS 10, IAS 16, IAS 36 impairment, IAS 37 provisions, contingent liabilities, and contingent assets. Last but not the least, IAS 38 intangible assets. Am I clear now? Okay, Levani, can you confirm? Have you noted it down? That's great, Sanjay. Yes, Sanjay, you got to work on your accounting standards. These accounting standards should be your strength. Okay. Thanks. Okay, most welcome, most welcome. Okay, I'm done with the first question. Let's quickly go through the solution and then we'll have a break. The company values its inventory at the lower of cost NRV. There is a risk that those general overheads include certain items which are not relevant to production. As a result, inventory could be overstated. So this is all what we discussed, right? What about this response? We need to have a discussion with the management and we need to make sure that there is no non-production item in the general overheads. And if there is any non-production item, we need to request the management that they need to write it off. The company undertakes full year-end inventory count. There is a risk that there are certain adjustments which leads to material misstatements in the inventory. Year-end inventory could be misstated. What should be your auditor's response? You have to try to attend the inventory count and you need to make sure that all those good dispatch and good receive notes, you need to perform that reconciliation by yourself. Remember, the client has charged 1.1 million as an expense and that is not in compliance with IAS 38. This is not correct. This is not a risk. The sum has been fully expensed and this is not correct in accordance with IAS 38. What should be your response? We need to have a discussion with the management and we need to understand why they did that. And we need to make sure that they recognize it as an asset and then charge amortization. The company has raised 1.2 million by issuing shares. There is a risk that they have not correctly split the share capital and share premium. What should be your auditor response? First of all, you need to make sure that 1.2 million was received and we need to make sure that they have correctly performed the accounting treatment. That is, they have correctly split into share capital and share premium according to the company's constitution, according to the company's nominal value. Moreover, you need to review the disclosures that they are fully disclosed. Is this clear? I think I can skip the solution for okay. One last. The 360,000 has been recognized and this should not have been recognized. So in order to comply with IAS 37, this is not correct. Their assets are overstated and their profit is overstated. This is not correct. There is no risk. This is not correct. What should be your response? You need to have a discussion with management why they have incorporated it, and considering it's not certain, their accounting treatment is not correct and they need to write it off. And if it is probable, they are only allowed to recognize if it is probable, they only a contingent asset can be disclosed. Is this clear? Okay, I'm done with the first question. Now please, one important thing, whenever you are having an auditor's response, whenever you are writing an auditor's response, never ever, please concentrate. Whatever I'm saying, please concentrate. Whenever you are writing auditor's response, never ever write the accounting standard in it. Never ever. You are not supposed to write according to IS 38 in the auditor's response. You are not supposed to write according to IS 38 intangible assets need to be capitalized. Don't say that. You are not supposed to write according to IS 30 IS2 inventory should be valued at the full production cost only. Don't write the correct accounting treatment or the accounting standard as an auditor's response. Write it somewhere. Write it somewhere. What I'm saying right now, in the auditor's response, I'm repeating it, write it somewhere. In the auditor's response, never ever write the correct accounting treatment. In the auditor's response, never ever write the correct accounting treatment. In the auditor's response, never ever write what the accounting standard says. Never ever write what the correct accounting standard says. Is this clear to everyone? Can I have a yes? Are we all clear up to this point? Okay, Hashir, thank you. Thank you. So bye bye. Thank you, Sonam. Okay, fine. Okay. We all are clear up to this point. Guys, I've got a very bad news for all of you out of nowhere. I am unable to give you a break. I'm so sorry to let you know. I need a break desperately right now, but I'm running out of time, and I've promised myself that I'm going to attempt 3 OTQs. So there is a question left, which is on your screen right now. Same requirement, audit risk and the auditor's response, but there are ratios as well and 3 OTQs. So I'm not giving you a break. Sorry. We will have break tomorrow. I promise that. Okay, let's go to the next question. Then we'll have OTQs. So hang on. What's the requirement? Again, a very, very, very recent past paper question. This is from 2019, I believe. Describe the auditor's responsibilities in relation to the prevention and detection of fraud and error. Can I skip this part A? Can I skip this part A? Because this is a knowledge base and we have already covered that. Can I skip that? Thank you very much. Yes, we can skip that because this is the onus and the liability is on you. You got to type it and you got to learn it. Thank you, Varda. Thank you, Azra. Thank you, Emma. Thank you, Navneet. Thank you. Okay, let's go to part B. Calculate 4 ratios. 4 ratios means 4 marks, but you have to calculate ratios for both years, the last year and the current year. Why for the last year? Because the ratios alone stands nowhere. You got to compare the results of this year's ratio with the last year. So you got to calculate the ratios for both years. Please take out your calculators. You have to calculate gross profit margin, inventory holding period, gearing ratio, and interest cover. Your time starts now. I'm giving you complete 2 minutes. Start with the gross profit margin and note them somewhere. Gross profit margin. Gross profit margin. Gross profit 4,500 divided by revenue 23,200. Okay, you're right. Gross profit is 19.4. And what about the gross profit for the last year? Thank you, Varda. You're right. The gross profit for the last year was somewhere around 21%. Fantastic. Let's go to the next ratio. After gross margin, you need to calculate what? Inventory holding period. 2100 divided by cost of sales into 365. What's the inventory holding period? Yes, you are right. Inventory holding period is 41 days. What was the inventory holding period for the last year? Yes, you are right. The inventory holding period for the last year was 1600 divided by 17300 multiplied by 365, that gives you 34 days. So the inventory holding period has increased. Whenever inventory holding period has increased, that creates a doubt in my mind that inventory at the year end could be overstated, because there is a possibility that my client is struggling to convert the year end inventory into cash. Maybe there are obsolete items in the stock, there are certain unfashionable items in the stock, maybe the NRV of the cost, sorry, the NRV of the inventory has gone below the cost, and as a result inventory could be misstated. Okay, what's the gearing ratio now? Gearing ratio, long term debt, which is 1300 divided by, let's say, 13,000 plus 10,000. 13,000 divided by 2300. 13,000 divided by 23,000, or 13 divided by 23 simply. What's the gearing? Yes, you are right. The gearing ratio is 56%. And what's the gearing ratio for the last year? What's the gearing ratio for the last year? Yes, you are right. The gearing ratio has increased, because this year it is 56 something and the last year it was 53 something. Gearing ratio has increased. What about the last ratio? Interest cover. Interest cover. What's the formula for interest cover? Profit before the finance cost, which is called the operating profit. So profit before tax is 450 and the finance cost is 290. So first of all, you got to add 290 in the 450. You got to create the profit before interest. So 450 plus 290, and then divide by the interest expense 290. 450 plus 290, whatever it is, then divide by 290. What's the interest cover for this year and the last year? Yes, you are right. All of you are right. The interest cover has gone down quite a lot, from 4.4 to 2.6. Now please realize the gearing ratio has increased, the interest cover has gone down. Those two factors, if they are combined into one, that creates a potential problem for my client, which is if they are seeking more finance, they will not be able to get it so easily. Because if the gearing ratio has gone up and the interest cover has gone down, that creates a problem for the company. That is, it will be harder to get the finance loan. The acquisition of more loan will be a troublesome now. Okay, yes, that could create going concern problem, but don't go for going concern straight away. Don't go for going concern straight away. Okay, so we are done with 8 marks. Okay, we are done with 8 marks. What about the last 6 marks? The last 6 marks have got to do with substantive procedures. I will be covering these 2 requirements on day 3, at the end of day 3. So for now, you have to skip the part D and part E. We are only left with 16 marks for the day. Using the information provided and the ratios calculated, using the information provided and the ratios calculated, you have to describe 8 audit risks and then explain the auditor's response to each risk in planning the audit. Remember, 8 audit risk means there could be risk of material misstatement, there could be detection risk. What's the exam technique for risk of material misstatement? Which financial statement items understated or overstated, and you have to explain why the client's accounting treatment is wrong, or why you think that the client's accounting treatment is wrong. What about detection risk? Auditor might not be able to detect the material misstatement because this is a new audit client, because there is a time pressure, blah blah blah. What about the auditor's response? Your response should be in accordance with the risk. Let's start reading the question. Let's be a bit quick. It is 1st July 2015. You are an audit supervisor of the audit firm called Brooklyn and Company, and you are planning the audit of H company for the year ending 30th September 2015. The company has been a client of your firm for several years. That's heartbreaking for me, because I was desperate that this is a new client so that I can score 2 marks by recognizing that there is a detection risk because of the new audit client, and I need to maintain skepticism. I need to devote more time, more resources, more sample size. But unfortunately, I can't score those 2 marks. How sad am, how disheartening and heartbreaking is this? It's all right. Let's move on. The life goes on. We need to learn how to move on. Okay. The company has been a client of your firm for several years and the manufactures car tires, selling its product to wholesalers and retailers. The audit manager attended a planning meeting with the finance director and has provided you with the following notes. So nothing in the first paragraph, nothing. Is this clear? Yes, Adil, you are right. Okay, let's start the question. Let's start the main event. The company sells approximately 40% of its tires to wholesale customers. These customers purchase goods on a sale or return basis. Oh, that's tricky. If there is a sale or return basis, there is a possibility that some of the revenue might not be allowed to recognize as a revenue because that could be returned by the customer. Okay, let's continue the question. IFRS 15 does not allow to recognize 100% of the revenue if there is a certain proportion which is usually returned by the customer. If you're not good at IFRS 15, if you don't know what is IFRS 15, it's all right. We can still attempt this one. The company sells 40% of its tire to wholesale customers. These customers purchase goods on a sale or return basis. Under the terms of the agreement, wholesale customers have got 60 days during which any items can be returned without any penalty. The 100% can be returned, 90% can be returned, 5% can be returned. Historically, the client has maintained 10% as a return rate. So historically, what does the client do? If they are going to make a sale of $100 using the principles of IFRS 15. If you don't know what is IFRS 15, let me tell you, it's a standard about revenue recognition. That standard says that you need to recognize $90 out of the $100. Why? Because generally speaking, 10% sales are returned. You need to recognize that 10% as a liability. Imagine there is no return out of that $100. Once the 60 days have gone by, you can perform an adjustment and that liability will be converted into revenue, that into income. That's what IFRS 15 says. The finance director has historically assumed a return rate of 10%. However, whenever I read however, I become on my toes because I know there is a risk coming up. The auditor, the finance director, however, now feels that this 10% is very, very excessive and they want to or they intend to change this to 5%. What's the risk here? What's the risk here? There is a risk. Can you tell me in the question box? This will take time if I'm going to ask you and see the question box, but let's not worry about the time. Let's make sure that we are going to pass this exam. Forget about the 3-hour benchmark established by ACCA. What's the risk? Can I get an answer from you? What's the risk here? What item could be overstated? Yes, Hassan Abdullah. Yes, Mavish. Yes, Ahmed, revenue could be wrong. Yes, Hashir, B, skeptic, overstatement of revenue. Yes, Hashir. Yes, Kalavani. Yes, fantastic. Yes, fantastic. Revenue could be overstated and the liabilities, well done, Neha, well done. Yes, the liabilities could be understated. Why? Because that particular chunk of 5% which the client might have recognized as revenue should have been recognized as liability. So the finance director's assumptions could be wrong and revenue could be overstated and the liabilities could be understated. Yes, Navneet, fantastic. You have got a very huge potential. Well done. What's the response? We need to have a discussion with the finance director regarding the assumptions he has used about this 5% rate. And if those assumptions are reasonable, it's all right. And if those assumptions are not justifiable, we need to make sure that they readjust that. And we might want to review the post year end period in order to figure out whether the return rate is equivalent to or more or less equal to 5% or not. If that return rate is more than 5%, definitely the revenue is overstated. Definitely the liabilities are understated. So if there is significant Yes, Sarosh, we need to have a discussion with the management regarding their assumptions. And if those assumptions are reasonable, that could be verified through post year-end return rate. Well done. Is this clear? The first point, the first audit risk, the first response. Can I have a yes? Hira, yes, cost of sale as well. Yes, cost of sale as well. Thank you. Let's continue the question. The company purchased a patent on 30th September 2014 for 800,000, which was capitalized in the prior year as an intangible asset. So they purchased a patent last year for 800,000. They purchased an intangible asset last year. Remember in the last question, the client purchased an intangible asset and all of a sudden they charge everything in the profit or loss account. But this question is different. This time the client has capitalized. If they have capitalized, they should have amortized it, right? 800,000. But guess what? Their intangible assets were at the end of the last year were 800, and at the end of the year this is last 800,000 as well. What's the risk here? What's the risk here? You tell me. I will add everyone in the WhatsApp group. You don't have to worry about this issue. Okay. What's the risk here? Yes, there is a risk. In fact, there is not a risk. The client's accounting treatment is wrong in accordance with IS 38. Their intangible assets are overstated and their expenses are understated because they have not amortized the intangible assets in accordance with its useful life. So which financial statement item is at risk? Intangible assets are overstated and the amortization expense is understated. As a result, profit is overstated. Why? Because client's accounting treatment is not correct in accordance with IS 38. They have not amortized it. What should be your response? I think you need to agree the useful life of that patent through the supporting documents, and then you have to make sure that client charges the amortization expense in the profit or loss account. You need to make sure that they have now performed the adjustment and their adjustment is correct. Is this clear? Okay, I have sent the WhatsApp group invitation link to the ACCA webinar team. They will share that invitation link with you. If they are not going to share, or if there is any technical difficulty, they will share my number and I will share the link. Please, everyone, please calm down. Please, all of you, calm down. And we don't have to worry about the WhatsApp group right now. There are far more important things going on. Don't worry about the WhatsApp group. Let's continue the question. In preparation for the manufacture of the wet weather tires this year, the company conducted a review of its plant and machinery. As part of this review, surplus items of plant and machinery were sold, resulting in a loss on disposal of 160,000. This is very, very, very important, and only extraordinary students can understand that. And you have to be one. You have to be an extraordinary one. If your client is facing significant profits on disposal of property, plant, equipment, if your client is facing significant losses on disposal of property, plant, equipment, those significant profits or losses on disposal, they are an indicator that the depreciation policy and the depreciation rates applied by the client are not appropriate. Usually or generally speaking, if the depreciation policy and rates are appropriate, there is a matching concept going on and there are no unusual significant profits or losses on disposal. So if there is unusual profit or losses on disposal, that creates a doubt in my mind that their depreciation policy and their depreciation rates could be wrong, and as a result, Non-current assets could be overstated and depreciation expense could be understated. Because there is a loss, I believe that non-current assets could be overstated and depreciation could be understated. I need to recalculate the loss on disposal just to make sure that the loss on disposal is appropriate. I need to have a discussion with the management that their depreciation policy is in line and their assumptions are appropriate and valid. Is this clear, the whole point? Can I have a yes? Yes, Ulkanan, you are right. Yes, Mavish, you are right. Yes, absolutely, all of you are right. Thank you everyone. Thank you, Subhash. Thank you, Ifra. Well done. Thank you, Ahmed, Sonam, Claire. Thank you, fantastic. Let's continue. In 2015, May 2015, the financial controller of the client was dismissed after it was alleged that she had carried out a number of fraudulent transactions against the company. She has threatened to sue the company for unfair dismissal as she disputes the allegations. The company has only recently started to investigate the extent of the fraud to quantify the required adjustment. Remember, in the last question there was a fraud going on, and I told you when a fraud has been discovered, there is a potential risk of material misstatement. Can you tell me in the question section what's the risk here? Can you tell me what's the risk here? Apart from weak control system, Mavish, another risk. There is a risk. No, I'm not asking for provision. What that Sarosh, that provision, that Somya and Sarosh and Atar, that provision thing has got to do with the claim. I'm not asking about the claim right now. What about the fraud? The fraud leads to a risk of material misstatement. What's the fraud? Yes, Hera, you are right. Ajwa, you are absolutely right. And Nabil, you are right. More frauds. There is a risk that the complete picture of that fraud has not been quantified. There is a risk that there are other frauds which have not been fully discovered or uncovered as yet. Maybe the frauds have not been quantified as yet. Yes, we need to be more skeptical. Ashir, you are absolutely right in the response. On your toes. Yes, we have to remain on our toes now because there is a fraud going on. Well done. So that's one risk. And what's the other risk, which Sarosh and Somi have already expressed, that considering the fact that she's claiming and she is unfair dismissal, she's she's suing the company. So provisions for the unfair dismissal could be understated, or the contingent liability could be not fully disclosed. So there are two risks here. Number one, the complete quantification of fraud has not been made, so that leads to overall risk of material misstatement in the financial statements. The profit could be overstated. Number second, provisions and the contingent liability could be understated. Am I clear? Can I move on? Because this is all from the last question. This is monotony, this is repetition. If you are prepared for the previous question, you're automatically good in this one. Can I move on? Can I have a yes? Yes, sir, move on. Thank you very much, Nabil. Thank you, Rafi. Okay, a problem occurred in June 2015 during production of a significant batch of tires which affected their quality. Inventory seems to be at stake. The issue was identified prior to any goods being dispatched, and management is investigating whether the issue can be rectified and the tires can subsequently be sold. Which financial item is at risk? Inventory is at risk of overstatement. Why? Because there are certain items which are not in good condition. So there is a huge possibility that their NRV might be below cost. That leads to a situation which is called inventory is at risk of overstatement. Moreover, when we calculated the ratios, we calculated that the inventory days have gone up from 30 from what the days when we calculated the ratios, I think 40 to 30. When we calculated the ratios, the inventory days have gone up from 34 days to 41 days. That also confirms that inventory is at risk of overstatement. So which financial statement item? Inventory. What's the risk? Overstatement. Why? Because there are certain defective items, and as a result their NRV could be below cost. Moreover, inventory days have gone up, which also indicates that inventory is at risk of overstatement. Is this clear? What should be your response? You need to have a discussion with the finance director whether certain items of the inventory need to be written off. Moreover, you need to extend your post year end substantive testing regarding the NRV of those inventory. You need to verify that their NRV is above cost, otherwise inventory needs to be written off. Is this clear? Can I have a yes regarding this particular point? Abdul Rafe, I'm not going for the independent valuation because this seems to be not so tricky. So why would I hire an independent valuer and I need to pay for that? This seems to be quite straightforward. So don't go for independent valuer. Don't make this complex for yourself. Is this clear, Abdul Rafe, now? Yes, Maruk, you're absolutely right. If they have sold that particular consignment post year end, you got to agree to the sales invoices in order to verify that their NRV is above cost. Sarosh is saying, shouldn't we be affirmative? See, I don't know. I'm not 100% sure whether their defective items NRV is above cost or below cost. I'm not 100% sure. That's why there is a risk that is why inventory could be overstated. I'm not saying inventory is overstated. Sarosh, is this clear? Thank you. Navdeep is saying, when we say post year end substantive, do we have to list? No, you don't have to list the procedures. Okay, let's continue the question. The client's finance director has informed you that in March 2015, a significant customer was granted a payment break of 6 months and it has been experiencing financial difficulties. Each company maintains an allowance for trade receivables, allowance for the doubtful debt, and it is anticipated that this will remain the same level as the prior year. Which financial statement item is at risk of overstatement? Can you tell me? Thank you, Navdeep. Which financial statement item is at risk of overstatement, considering that your client has... Thank you very much and fantastic. Receivables are at risk of overstatement and the allowance for the doubtful debt is at risk of understatement. Why I'm saying that? Because a significant customer has been granted a break. Moreover, the receivable days have gone... Have you calculated the receivable days? No, you haven't. But is there any data to calculate the receivable days? Where is the question? Is there anyone who can calculate the receivable days? Is there any data for receivable days? No, there is no data for receivable days. Okay, fine, leave it. So considering there is a significant customer which has been given a huge break, there is a huge risk that that client might not be able to pay you off, and as a result your year-end receivables might be overstated. Is this clear to everyone? What should be your response? I think you need to first of all have a discussion with the management that on what assumptions they truly believe that that client is going to pay. Maybe you would like to review the correspondence between that particular customer, that key customer, and the client in order to understand what are the chances of payment. And if it is possible, you would like to review the post year end payment period or bank statement in order to figure out whether that client has actually paid or not. Okay, the report to the management issued by Brooklyn Company following last year's audit highlighted significant deficiencies relating to the client's purchase cycle. So last year there were significant deficiencies in the purchase cycle. So if there were significant deficiencies in the purchase cycle, this is a significant control risk. And I told you in the last question as well, if there is a certain portion of control which is not good enough, so if the controls are compromised, as a result the financial statements becomes vulnerable. So the year-end payables and purchases could be misstated. They might not be complete because the controls are not that great. Let's quickly finish off this question. The finance director has informed you that company intends to restructure its debt after finance after the year end and will be looking to consolidate its loan to reduce overall cost of borrowing. So the company wants to get more loan. If the company intends to get new loan, their gearing ratio have already increased, their interest cover have gone down. I think the company might struggle to get new loans. And if the company wants to desperately get a new loan, and they might struggle to get the new loan, there is a huge possibility that they are going to cook the financial statements. There is a huge possibility that financial statements might be materially misstated. Their worsening interest cover and gearing ratio indicates that it will be harder for them to get the loan. But in order to get the loan, they might overstate the revenues, overstate the assets, understate the liabilities, understate the expenses in order to come up with a better picture. So what should be your response? Can you tell me in the question section what should be your response? If you are going to, Vishaka, if you are going to use a ratio here, you just have to say, considering the receivable days have gone up, considering the inventory days have gone down from 40 days to 50 days, something like that. Yes, Rehan Iqbal, you are absolutely right. Navneet, you are right. You have to remain professionally skeptic, and you should ensure that you devote most experienced staff, you devote more time on understanding the client, you need to remain skeptic. All those judgmental areas need to be audited by the best quality audit staff. Well done, well done. Okay, last point. Each company has not paid its shareholders a dividend this year, choosing instead to undertake a bonus issue of its 0.5 equity shares. What about bonus issue? You need to know what's the accounting treatment of the bonus issue. Whenever bonus shares are issued, the share capital is credited, and the reserves, that is the share premium or any other reserve, is debited. There is a risk that the client has not made the correct accounting treatment, and there is an additional risk that they have not fully disclosed this thing. When bonus issues are made, if you have got share premium, that is debited, that is reduced, and your share capital is credited, that is increased, and all that thing should need to be fully disclosed. There is a risk that client has not made this accounting treatment clear and they have not fully disclosed it. What should be your response? I think you need to review the accounting treatment made by the client in accordance with the bonus issues, in accordance with the company's uh, share issues and share certificate and share register, and you need to make sure that they have made correct accounting treatment and they have fully disclosed all that thing. Is this clear? Can I have a yes regarding the bonus issue? Yes, sir, Fatma, you're right. Yes, Nabil. Yes, Ashir, absolutely. Fantastic. So finally, we are done with another question of the risk. Fantastic. We are not done as yet. Sir, could you please explain again the bonus issue? Okay. If you are Mr. Khalil, if you are going to review the board of minutes, that will not verify whether the accounting treatment performed by the client is correct or not. What's the risk here? Please understand what's the risk. The risk is the bonus issue made by the client. Okay, fine, it is made by the client. Definitely it is approved by the board of directors. The risk is the client's accounting treatment might not be correct. So your response should be focused on the client's accounting treatment. If you are going to review the minutes, that will only verify whether the bonus issue was verified by the client or not. So no, I don't agree with the reviewing minutes of the meetings. Yes, Ajwa, you can review their accounting treatment in accordance with the articles of association, just to make sure that it is in line, the share capital and the share premium in accordance with the articles of association. Yes, you're right. Mavish, as far as the marking scheme, I'm running out of time. I will come up with marking scheme either tomorrow within this webinar. Don't worry. Okay, somebody asked me that I need to explain again the bonus issue. If the client made a bonus issue, they have not received any cash. They need to debit their share premium, that is, they need to reduce share premium account or any other reserve, and they need to credit share capital account. Okay, that's the double entry for the bonus issue. As an auditor, there is a risk in my mind that the client has not made the correct accounting treatment, and moreover there is a risk in my mind that they have not fully disclosed everything. So what should be the response? I need to review their accounting treatment and I need to make sure that their disclosures are adequate. Is this clear now? Is this clear now? Azra, it is recommended that you explain that the accounting treatment is not correct in accordance with IS 38 when you are explaining the audit risk. Don't refer accounting standard or in the response. Try not to refer accounting standard in the response. whatever you are saying, that is correct, but you have to explain it in the auditor's response section. Sir, but the client issue instead of dividend pay. Yes, that does not create any difference. The client has not paid the dividend. Forget it. Forget it. They didn't issue the dividend or paid the dividend. Focus on that. They have issued the bonus issues. Mohammad Adil, thank you very much. That means a lot. The client have liquidity issue. The client have liquidity issue. No, I'm not going for the liquidity issue because I don't have data for current ratio, quick ratio, payable days. If the question had the data of current ratio, quick ratio, and payable days, current ratio have gone up. Sorry, the current ratio have gone down, quick ratio have gone down, payable days have gone payable days have gone up. I would have concluded that the client is facing liquidity problems. That creates going concern problem, and the client needs to fully disclose that going concern problem. If they are not going to disclose going concern problem, I will treat it as if this is what? This is an audit risk because of the lack of disclosure. Is this clear? Mohammad Nadeem, nice to hear from you, but the webinar is not finished as yet. No. If a company issues bonus issues, that does not necessarily mean the company is having liquidity problems. But if the company is issuing bonus issues and their current ratio have gone down and the quick ratio have gone down and the payable days have increased, now that creates a going concern problem, liquidity problem. On its own, don't say that. Yes, the shareholders could be frustrated because they haven't received the dividend, but they have received the bonus issue, right? So next morning they can go to a broker and they can sell off their shares and get the cash. How does that sound, Abdullah Faye? Bonus issue is a common thing. Okay, we all are crystal clear what we have achieved today. We have achieved that the knowledge base is there. We definitions of audit risk, detection risk, risk of material misstatement, inherent risk, control risk, risk of material misstatement, materiality, the definition of materiality, the definition of performance materiality, the definition of factual misstatement, projected misstatement, projected misstatement, responsibilities of auditor when it comes to fraud. This is all knowledge based. Now comes the last part, OTQs. At least we should go for one OTQ, right? At least let's explore one OTQ. At least I will make it up tomorrow. Tomorrow we are going to do 2 more from the risk. So this is planning and risk assessment. This is planning and risk assessment, right? Let's solve at least one OTQ today, and we are going to solve 2 more OTQs regarding the planning risk assessment tomorrow, along with the OTQs on controls. Actually, the first session of the webinar is always a time challenging because I need to build up everything. I need to tell you why this paper has got such a high failure rate. That is why this is a bit time challenging. Last 10 minutes maximum, or maybe less than that. It is 1st July 2015 and you are planning the audit of V company for the year ending 31st July. V company is a new audit client. Yes, finally I got the new audit client, which operates in the oil and gas exploration industry. Companies wishing to operate in this industry require a license. Oh, license, it's tricky. Licensing authorities take into account public health and safety. So there are certain strict laws and regulations, and protection of environmental laws and biological assets as well. V companies' activities are geographically spread across 3 continents. 3 continents. That means foreign currency transactions could be there. We company has been in existence for 30 years and has grown its revenue at an average of 12% growth. This is in line with the industry average, 12% growth. During the year planning with the meeting, the finance director, you were informed that the profit before tax for this financial year is 9.5 million as compared to the last year. So there is a huge increase in profit. Last year it was 6, this year it is 9.5. That's more than 50% growth in profit. Based on the revenues of 124 million this year, last year it was 100 million. So what's the growth? This seems to be 24% growth, although the industry average is 12%. Now that's this is fishy. This is unusual. The revenue has gone up by 24%, although the industry average has gone up by 12%. Similarly, the profit has gone up by a huge percentage, more than 50%. You have completed the audit strategy and the risk assessment section, in which identifies the following as an areas of significant risk of material misstatement. So there are 5 significant risk of material misstatements. 5 significant risk of material misstatement. Number 1, overstatement of receivables due to long outstanding debts. Overstatement of receivables. So receivables could be overstated. Why? Because there are long outstanding debts. There is a huge time certain debtors have not paid. That sounds reasonable. Misstatement of intangible assets. Certain intangible assets could be misstated due to incorrect amortization. That could be possible as well. Because there are certain intangible assets, according to the question, they have got certain rights and something like that. Overstatement of non-current assets due to impairment of exploration areas which have been decommissioned. So there certain sites have been decommissioned, their certain exploration sites have impaired, and as a result their non-current assets could be overstated. That sounds reasonable as well. Overstatement of inventory due to inherently difficulty of establishing the quantity of oil, gas and reserve. That sounds logical as well, because these are very judgmental areas. In order to establish how much reserve is there, how much gas or fuel is there, that's judgmental. Okay, now comes the question, which, please concentrate, a good student is going to get at least 4 correct answers out of the 5. This is very tricky and this is do or die. This is the turning point of this September 2021 attempt. Which of the following is the least significant audit risk? It means all 4 could be audit risk, but one of them is least important, least significant according to the situation of Varian company. Least significant audit risk. I am going to stop for 30 seconds. You try to figure out which is the least significant risk according to the question. 30 seconds. All of you have got 30 seconds. Some of the students are saying option A, non-compliance with laws and regulation. My dear students, this particular client operates in a highly regularized sector. There are very strict laws and regulations concerning the environment, concerning the public health and safety, concerning the biological assets. There are very strict licensing rules. So the non-compliance with the laws and regulations, this is a huge audit risk, because the laws and regulations are so many. If there is any potential non-compliance, that creates a material misstatement. So A is a huge audit risk, not a least significant audit risk. So those who have answered A, that's not correct. Now some of you are answering option D. Now why option D is not correct? Because this client has got presence in 3 continents, and if a company has got presence in 3 continents, automatically that company is exposed to foreign currency fluctuations. And if your company is exposed to foreign currency fluctuations, your year-end expenses or year-end payables or year-end receivables could be misstated because of the foreign currency fluctuations. That is not a least significant risk. In fact, that's a huge risk. So option D is again not correct. You have to identify the least significant risk, not the huge risk. See, I told you the OTQs are a killer. They are killer. A is not correct answer. D is not correct answer. Definitely C is not correct answer. Nobody has answered C. Why C is not a correct answer? Because provisions and contingent liabilities are a very important part of this audit, and their adequacy, their disclosures, the provision, the adequacy of the provision and the adequacy of the disclosures related to content. This is a huge risk. Client might understate provisions. Client might not fully disclose the liabilities. So this is a huge audit risk. We have to identify the least significant audit risk. What's the least significant audit risk? That is the understatement of trade payables, because this particular company might not have trade payables, or their trade payables might be very immaterial. This company does not purchase raw materials. This company might be having very low trade payables. In fact, I believe there would be zero trade payables or immaterial trade payables. Trade payables are different as compared to payables for the employees when it comes to wages. So trade payables would be either nothing or very immaterial. That means, or this means, that the risk of misstatements or understatement of trade payable does not seem to be a high audit risk area. So the option B is the correct answer. Are you all clear now when it comes to this particular question? Can I have a yes? Thank you. See, this is tricky. Let's go to the next question. Which two of the following are appropriate responses to address the increased detection risk due to we company being a new audit line? Is this a new audit line? Absolutely yes, and I'm loving it. What should be your auditor's response? What should be your auditor's response? So again, I'm giving you 30 seconds and you need to come up with two responses. By the way, if you are going to tell me one correct and one incorrect, how many marks you are going to get in the final exam? If your answer is one answer is correct, one answer is incorrect, you are going to get zero. Yes, zero. Why? Because software does not know the incorrect combination. So just imagine your answer is 1 and 2, but the correct answer is 2 and 3, or software does not know 1 and 2 is, software only knows 2 and 3. Section A will be tested by the software, so you are going to get 0 marks. Now tell me the correct answer for the question number 52. I'm giving you 30 seconds. There are many students referring option A as a correct pair, and I'm so sorry to let you know option A is not a correct answer. Why would you extend control testing? Are you dead sure that they have got good controls in place which you want to test? You don't know what kind of control system they have in place. Until or unless they've got a good control system in place, why would you test them? Why would you extend the testing? This is a new client. You don't know anything about them as yet. So option A is not a correct answer. I'm sorry. Greater majority have selected obtain and understanding. That's absolutely perfect, because this is a new client. You need to devote huge time and on understanding. Once you have understood, maybe then you might go for extended control testing, but not now. So option 1 is not correct. Option 2 is correct. Why would you consider relying on the work of expert? Why would you need an expert? This is a new client. Okay, fine, this is a new client. You can handle this, man. Why would you go for the expert? 3 is not correct. Reduce reliance on test of controls. No, if the controls are in place, we would increase testing of controls, but first of all, we need to make sure that controls are in place. 4th is not correct answer. Yes, we need to contact the previous auditor, because this is the first year we are auditing. In the next year, we don't need to contact the previous auditor, because in the next year, the previous auditor will be us. So the correct answer is 2 and 5. Is this clear to everyone? Can I have a yes? Thank you. Which of the following is the least appropriate materiality level to be used in the audit of V company? Least appropriate materiality level, least appropriate. Automatically my mind says that the bigger the materiality level is, the least appropriate it would be, definitely. But if you are going to even calculate the materialities, you will find that this is the least appropriate. Okay, let's continue. This is a very, very, very difficult question. 54. Select whether the following statements are consistent or not consistent with the movement in revenue. What's the movement in revenue? First of all, you got to understand what's the movement in revenue. The revenue has, where is the revenue? The revenue has gone up by 24%, huge jump. Although the industry average is 12%, huge jump. Okay. Select whether the following statements are consistent or not consistent with the movement in revenue. If the revenue has gone up by a huge 24%, what do you think as an auditor? Cut off of revenue, is this an audit risk? What is cut off? The revenue should be recognized in the correct accounting period. Do you have this apprehension in your skeptic mind that client might have recognized the revenue for the next year's audit in this particular period? The client have recognized the next year's revenue in this particular period. Do you have this doubt in your mind? Do you have this doubt in your mind? Yes, if you have this doubt in your mind, I believe that cut off is an audit risk with respect to revenue. Now that's consistent. That risk, according to the movement of revenue, that's a consistent audit risk. That is consistent. That data and that cutoff, they are revealing that this is an audit risk. Second, completeness of revenue is an audit risk. What does completeness means? Some of you might not understand what completeness means. Completeness means that all the revenue which should have been recognized, whether it has been recognized or not. Completeness means whether the client has omitted something or not. Do you fear that client has omitted any revenue? Do you fear that client has omitted anything in the revenue? I don't think so. I think they have over recognized it. So the completeness of revenue is not an audit risk. I don't think it's consistent, not consistent, because I think the revenue seems to be overstated. Completeness, if completeness is at stake, the revenue would have been understated. So it's not consistent. Do you fear that some of the revenue might not have occurred? Do you fear that there are fake revenues recorded by the client? Do you fear that there are certain revenues which are fake? 100, 124, such a huge jump. Do you fear there are fake revenues? Yes, it means the occurrence of revenue. What does occurrence means? That all the revenues which the client has recorded should have occurred. They should not be fake. Do you fear that occurrence is an audit risk here? Yes, it is an audit risk consistent. Are you all clear with 54? Can I have a yes? Because that was a very tricky question. Mavish, you can calculate materiality by using a mnemonic called RAP. 0.5% to 1% of revenue. RAP. 0.5% to 1% of revenue. RAP. A for assets. 1% to 2% of assets. 5% to 10% of the profit. RAP. R-A-P. RAP. So if we are going to calculate 10% of assets, 10% of profit, 2% of assets, we'll figure out that the materiality level of 1.5 million is extravagant. So that's the least appropriate materiality level. Yes, the less the materiality level, less the audit risk, less the better, more the chances of identifying the material misstatement. You're absolutely right. Okay, let me finish this particular MTQ, please. Match the audit risk given with the most appropriate responses the auditor of V company should take. What we studied today, that's the test of it. What's the audit risk? Receivables could be overstated. What's the audit risk? Non-current assets could be overstated. What's the audit risk? Intangible assets could be overstated. How I'm saying that? Overstatement of receivables, overstatement of non-current assets due to impairment, overstatement of misstatement of intangible assets due to incorrect amortization. Now what's the response? I'm giving you 60 seconds. You need to come up in the question box 1A, 2C, 3F, something like that. Receivables. Receivables. Non-current assets. Okay, now I'm done. Let's see what you have answered. Let's see what you have answered. B is not an answer. A is not an answer. Unfortunately, you guys are not doing that great. Anyways, receivables. How can I verify? What should be my response? If the receivable seems to be overstated due to long outstanding debts, I think I need to make sure that I review the correspondence between my client's debtors in order to figure out whether the customers are willing to pay or not. So the first answer is 1E. Non-current assets. What about non-current assets? The non-current assets, overstatement of non-current assets due to impairment of exploration areas which have been decommissioned. So I think with respect to non-current assets, I need to review the depreciation charge for adequacy. I need to make sure that the useful lives are now adequately reflecting the impairment. The useful lives estimates have now changed. So 2G. What about intangible assets? Intangible assets, misstatement of intangible due to incorrect amortization. So that's easy. Intangible assets 3, recalculate the expected amortization charge, so that you can compare it with the client, make sure that it's correct. So 3F. Is this clear now? Can I have a yes, please? Okay. What is decommissioned? Overstatement of non-current assets due to impairment of exploration which have been decommissioned. There, for example, you were exploring oil at a certain place. You had your machinery and everything going on there, but now you have, you are done with it. Your whole program is over. Now you have to remove that machinery, you have to restore that place, you have to clean up that space. That is all decommission cost. You have to clean up, you have to pack it up, you have to restore. That's the decommissioning cost. Is this clear? Can I have a yes regarding this overall question? Can we not inspect exploration areas? They are done with the exploration area. Why would you go over there? Don't inspect that place now. Can I repeat the benchmarks regarding the materiality? Why not? Please write it down. I often use it as a mnemonic and I call it RAP. R-A-P, RAP. Some of you might be fond of rap music. RAP. Revenue 0.5% to 1%. But in the exam, you got to use the lower percentage, which is 0.5%. RAP. A for assets, 1% to 2%. But in the exam, you tend to use lower percentage, which is 1%. Last, profits, 5% to 10%. But normally we use lower percentage, which is 5%. I will be discussing this RAP mnemonic again on the day 4 of the webinar, so don't panic. Finally, I'm done with the day. I hope you found this particular day and this particular session very, very useful. I personally tried my level best. And one more thing, and then you are free to go. And that one thing is, give me a second. Give me a second. This is something important. Extremely important questions which you need to type and learn after this webinar under strict exam conditions when it comes to risk. The first question, which has got nothing to do with ratios, is called Harlem, which we just did today in the September webinar. It's a September 19, December 19 question available in your Kaplan kit, BPP kit, available on ACCA website. The second question which you need to attempt, type and learn is, sorry, that was with ratios. So second question is without ratios. It's called BlackBerry, which is from March 18, June 18, which we did today. If you want more questions, which you definitely want, the other question which I recommend is Centipede and Darjeeling, having ratios, and without ratios, Puny and Hurling. If you can do those questions by consulting solution on your own, fantastic. You don't have to check out the last webinar or the second last webinar. But if somebody is stuck somewhere and there is no one to help him or her out, then you can go and have a look at the previous webinars, such as June webinar is for Centipede day 1 and Puny company June webinar day 1. Similarly, Darjeeling company March webinar day 1, Hurling company March webinar day 1. So you don't have to check out the day 1 of the June webinar or March webinar if you can solve these questions by consulting the solution or with the help of solution on your own. If you are stuck, you don't understand a thing, only then you have to consult the previous webinars. I'm not suggesting or forcing or recommending previous webinars. Trust me, I believe this day was good enough. I believe that you need to attempt these questions, master these questions, and you will be ready for the audit risk questions. Please consult the solutions. Don't attempt on your own. I'm done for the day. I hope that webinar was helpful. Thank you very much. If you still have any queries and discussion, thank you very much. See you tomorrow. I will be starting and finishing controls tomorrow. I will be starting the day 2 tomorrow. Controls. We did audit risk today. We will do controls tomorrow. We will start at the same time tomorrow, which is 7 p.m. my local time. Check out your local time. Thank you everyone. Thank you everyone. Thank you.